Ladies and gentlemen, our program is about to begin. Please welcome Justin B. Smith, co-founder and CEO of Semaphore.
Good morning. How's everyone today? Good morning. I hope everyone's had coffee and food, and welcome to the second day of the World Economy Summit. We were so thrilled. I hope some of you were with us yesterday. There was just so many vibrant, exciting moments from Ken Griffin's gripping conversation about the state of the world and brand America to a whole range of deep policy conversations with European finance ministers. It was just a great day. And today is also going to be another phenomenal set of conversations. So please feel free to stay through us throughout the day. Lunch will be served as well. For those of you who weren't here yesterday, I'm Justin Smith. I'm the founder and CEO of Semaphore, which is a new global news company. We're 2.5 years old, and we were founded on a simple idea that actually journalism could be better. It could be more intelligent. It could be more transparent. It could be more global and sophisticated in its presentation. And most importantly, in this town, it could be nonpartisan and much more fact-based. And after 2 years, we have nearly 1 million subscriptions around the world. And we're really read by some of the leaders of the world, if I may say so. I know that's maybe not a humble comment, but I think it's really the truth. I ran into the CEO of Apple, Tim Cook, a few weeks ago, and he said, I wake up every morning and I read Semaphore. So for those of you who want to be more like Tim Cook, you can sign up and read Semaphore. The World Economy Summit we founded as a very young company. We were 2 months old, and the idea there was also relatively simple, which is why did the largest economy in the world, the United States, not have a singular, powerful gathering of global private sector leaders? And so we decided to fill that void. We thought Washington, D.C. was the best location for this. And so we founded it in 2023. the first year, and our co-chair, Penny Pritzker, last night gave a toast. She said she remembers it was a room of about 40 people. I think there are 5 CEOs. Last year, we had 20 CEOs. We thought we were doing well. And then this year, we actually are welcoming 200 CEOs from the Fortune 500, which makes this the largest CEO gathering in America. And we're very proud of that as a young, scrappy company to have asserted ourselves in this way. The conversations are focused on 2 broad macro objectives. One, how do we catalyze further growth in service of progress for humanity? And 2, how do we fortify resilience, obviously given the uncertainty, the changes, the disruptions of this shifting global economy. All the conversations are journalistic, and so are led by our newsroom and our journalists, and reflect a lot of the values I talked about of independence and transparency. We have 4 co-chairs, one who's here actually this morning, Henry Kravis. Penny Pritzker will be speaking later today as well. David Rubenstein as well, and Ken Griffin yesterday. And these are 4 really of the most blue chip leaders in global business and finance, and they've helped us pull this group together in the most wonderful way. And so I thank them for their leadership and their support. So now we're going to begin a series of conversations on global growth, the future of trade and the durability of global commercial ties. And our partner is BCG. I don't know if you know BCG. It's the Boston Consulting Group. And they are working with us on these sessions. And we're very, very lucky, and I'm pleased to welcome to the stage really sort of a legend in global business, sort of the CEO whisperer who's speaking to CEOs all across the world, advising them on how to manage their companies. The global chairman of BCG and the former CEO of BCG for many years, Rich Lesser. So Rich, please join me on stage. There he is. So before we get into it, I know your CEO whisperer did not come from your Wikipedia.
It came from a reporter, and then some people latched on. I wouldn't.
Do you actually whisper when you?
No, in fact, my wife insists she's never heard me whisper, that I have a very too loud voice, and she can't believe that that's the moniker that someone chose for me. But it's okay. It's not very
But what I mean, and for how many years have you been playing this non-whispering role? I mean, if you think back, I know you were CEO of BCG for over 10 years, right?
The interesting thing is, my first 24 years at BCG, I was entirely client. I did internal roles. I led New York and the Americas, but I was just a client-obsessed person, and I served very few clients over that time period, and I really worked deep within the organizations, as well as engaging with the CEO. It was only when I became the CEO of BCG that suddenly I couldn't serve my own clients anymore, and I really needed to travel the world. And it was like a whole new learning journey for me to be talking to CEOs all around the world and understanding what's on their minds and trying to share what we were seeing at the front lines, and they have tremendous insights within their own sectors, but they often are really interested to hear what's happening in other sectors and what are the analogies or the implications for them. So my world changed upside down in the beginning of 2013, and I feel totally privileged. I've learned so much.
I mean, just an interesting journey, and also what an interesting window into the world, into the global economy, to have all these personal relationships with these leaders across the world. That's worthy of an hour-long conversation in itself.
I feel very fortunate.
Yeah. Well, how are these people feeling these days?
Stressed. It's really hard. And the irony is how quickly.
How stressed? More stressed than COVID?
No, because COVID was people's lives. COVID was, could you run your business?
More stress than the financial crisis?
Probably not the depths of it. No, I don't. Well, first of all, it's different in the U.S. than in other parts of the world. In other parts of the world,
so U.S. CEOs super stressed.
I think very stressed, but I don't want to draw. I don't think it's right. Certainly not to COVID, where there were people's lives and your families and everything. That was a whole different level. And I think the great financial crisis, first, it went on for a while. I mean, started in September was when it got really bad, but it lasted through to January. We didn't know if you have Steve Ratner here. I just saw him this morning.
Yeah.
What Steve and that team did to saved the auto industry. We were a part of that. It was remarkable, the work of that team. And so I think there was stress that went on for months. I don't think we're at that level yet, but we're only a few weeks in. But the level of uncertainty that people are feeling, it's tough right now.
And how about non-U.S. CEOs? Are they feeling that same level of stress?
Well, first of all, a lot of them saw the U.S. I was in Europe right after the election, and I was hosting CEO dinners because we were sharing what they should expect from the new administration. What were the priorities? What would it mean? I had multiple CEOs say to me, I know I'm based in Europe. Think of me as an American company. My best opportunities are investing in the U.S. I am excited to come here. I'm optimistic.
Well, I mean, Bernard Arnault went to the inauguration, came back to Paris, and gave a speech to the French press saying, you know, where are the animal spirits in France? Everything's happening in America.
But he was not alone in feeling that. So for many, many CEOs around the world, when you ask them, what's your best investment prospect? The U.S. was the top of the list through that inauguration day or even several weeks after. So I don't think we should view this as just a U.S. CEO challenge. It's a challenge for the business world around the world, and even companies that don't necessarily have big operations in the U.S. are often selling to U.S. businesses, selling into the U.S. market. So it's the biggest economy in the world. It doesn't touch as many of the world's supply chains as China does, to be very clear, but it still touches a big part of the world.
Are Chinese CEOs stressed?
Of course.
Yeah.
Can you imagine? I mean, you've been building a business for years, and you've got tens of thousands of workers, and these tariffs are at 145%. You just can't sell.
I think they came down yesterday, didn't they?
Oh, sorry. I've been hanging out with you too much. Okay, I've been hanging out with you too much. But it's still, no, I think that's what I'm saying. Like, it's not just a U.S. CEO thing.
Yeah. So I think what would be really fascinating for this audience is just the opportunity to kind of open that thick oak door into that room where you are with these CEOs, and you're the chairman of BCG, arguably the most intelligent advisory service for this sort of stuff.
Firm,
no,
maybe.
No, but at least one of several.
No, as a firm, it's terrific. I thought you were talking about me. Okay, so
no, the firm.
All good. BCG's amazing.
Yeah,
I'm 100% with
the firm. But you're there in the room, and I think what would be so fascinating is to actually understand, like, what are the private conversations like? What's the stuff? Because CEOs are so focused on jargon and sort of talking points and PowerPoint, blah blah blah. Like, what are the actual private conversations that you're having like?
What's interesting to me is, of course, you start with sort of the macro forecast, the GDP impact, the inflation impact, the consumption impact. But the honest answer is no one knows for sure where it's going. Our view of that may be just a tinge more optimistic than the average, but we're right in the range of others. So that's stuff they're reading about and hearing about from the various economists and groups they read. So we end up going onto 3 different topics, and it depends on the CEO and the situation, of course. One, for almost all of them, is the cost of uncertainty. We talk about tariffs and the sort of tax-like implications of tariffs, but uncertainty essentially is a tax on action. It's a tax on investment. It's a tax on buying decisions. And I think the uncertainty weight right now is really, really high and it flows through the whole economy, but let's start with investments. The deal environment has slowed dramatically from unbelievably optimistic, way above average optimism in December and early January, to now being frozen's overstated, but really slowed. As one of the big investors put it.
And Jan, February, and March, strong too?
No, I think the shift was a February shift. It became clear that the tariffs were being a bigger deal. So I think it was a mood shift that culminated on April 2nd. But it shifted from, I'd say, early February to early April. And as one of them put it to us, if I can't do a 2 to 3 year EBITDA forecast, I can't do a deal. Like, I got to have certainty. I can't have certainty forever, but I need to be able to look 2 or 3 years out and see what I'm getting, and people can.
So without naming names or industries, I mean, what are these conversations like? I mean, they literally are, I was about to break ground with a new plant, and now calling up the construction company and saying we're not doing that, or about to make a deal, or give us.
So I was talking. Okay, so just to take that example, I was with someone He's a leader of one of the big infrastructure portfolio companies, more than $10 billion of assets under management, so a serious player with assets in the US and Europe. They had just come from a call where everything was like people just were stopped. They didn't know what to expect. They didn't know what to do. They were just stopping investments for now, hopefully as short a time as possible. But that's the infrastructure side. On the manufacturing side, as I said, many companies want to come to the US. So the desire to invest in the US would only be heightened in a higher tariff world. That's true. But there's, for many others, it doesn't make economic sense. It's too high cost here. It would take years. The supply chains aren't here.
For a manufacturing-based company who's enthusiastic about investing in the US and is therefore, that enthusiasm is accelerated by the tariffs, what is the average timeline for making a decision on capital expenditures shovels in the ground to manufacture?
Years. And part of stuff that isn't going away. Permits are hard, other things are hard. But the challenge right now is not for necessarily the people who knew they needed to be here anyway, who often went to the White House and said, we're going to put billions of dollars here. For them, it's the problem of half of industrial, a huge amount of industrial supplies that you use to build in the US come from other countries. So you have an issue of, well, when do you start to build and how high cost it will be? And how do you think about the ROI on that spreadsheet for building when building just potentially went up dramatically in cost? Or you have to wait a long time till supply chains get rebuilt. Maybe some of the supplies you buy are brought back to the US. So for the people who are going to build anyway, it's just a question of when do I start? What's it going to cost? What's the return? For many others, it wouldn't necessarily make sense to be here. You can't be frozen forever, but it's a totally different world of tariffs are here, tariffs are here, tariffs are here. And so for them, the uncertainty of not knowing where it's going to land means it's better just to hold off right now.
So frozen uncertainty, what is the sort of the scenario here? Is it sort of some sort of equation, which is uncertainty times number of months times something else equals negative impact on GDP? Does uncertainty get lifted by anything other than just what is probably seems a little unlikely, a dramatic reversal and shift in policy?
Well, whether it's a shift, whether it's a modest reduction, or whether it's as is, the sooner people have a sense this is the world as it's going to be. It may not be the world you want, but it's the world you live in, and you make the best of it. As long as the swings could be so dramatic, then the value of waiting and learning more outweighs the value of acting. Our chief economist refers to it as strategic optionality. In a world of high uncertainty where you don't have control, then what you need to do as much as possible is build strategic optionality into your thinking. Figure out what are the no-regret moves, the things you should do no matter what. More flexibility in supply chains is like the most obvious. That when you don't know where tariffs and other things are going to go, then you better have a lot of room in your supply chain to be able to move. More pricing flexibility. Like a lot of companies have very rigid pricing systems. So the ability to actually flow a tariff through to the shelf that may be different this month than next month, and how to reflect pricing all the way through your value chains into your products. Companies, we've just not been used to price volatility in the way we could potentially have it. And so I think there's a lot of capabilities and muscle that you build. Productivity, using AI. You may not necessarily want to put capital in the ground, but you better be investing to be as productive as you can be in a more difficult economic environment. Maybe there are elements of your cost structure that are going to go up that you absolutely cannot control. So you better be using AI and all the productivity tools to the max.
I think I've heard you call them no regret.
Yeah, no regret moves.
Decisions.
There's a set of no regret moves, and I think every company right now is sitting down and saying, what are the things that make sense to do no matter what? And what are the trigger points or things that I would learn that would cause me to act differently than I'm acting now? And then what are the things that if they stay uncertain, I'm going to have to move anyway, and how long should I wait before I've got to take that call? I can't wait forever. But think how much time and effort in boardrooms around the world are going into those discussions versus how do I drive the next generation of innovation? How do I recruit better talent? How do I open up new markets? How do I leverage AI throughout my entire value chain?
So opportunity cost.
There's a time, management, a lot of the value of managers, the time and energy to devote to the things you think are most important. And when something is this short-term and high pressure, of course, it takes a lot of management time away from something else you wish you could be doing.
Let's get into the workforce question, because that's a whole other dimension to this. And I know you've done a lot of thinking about this, and maybe explain what you mean by the term workforce in this context.
Just in the last 24 hours since I've been here with you and your team, and by the way, you guys are doing a great job.
Thank you.
By the way.
Thank you.
But since I've been here, we had a major infrastructure player at one dinner saying they just couldn't hire people, and it wasn't they were paying. They had union wages, regularly. They couldn't. I had a manufacturer talk to us about how they couldn't get people, and I had a retailer say he thinks it's gotten so difficult to get people that people just don't even pursue opportunities they might because of this. So I think that one of the things we're not discussing is if we really wanted to bring hundreds of billions or maybe even $1 trillion of productive capacity back to the US, who would actually do it? Because right now we have a workforce that is near full employment, and we're frankly, in many of the places that were hit, and I think the president rightly points out, we decimated, I think that's the word he's used, communities, through all the manufacturing that left. And that is a really bad thing. And those communities have suffered way too much. But those people aren't sitting in those communities now waiting for things to come back. They've moved on. And so I think there's real workforce pressures that I hear all the time from companies that would like to build in the US. And their main challenge is, can they staff the plant with reliable workforces where people will be there? It's a real pressure point. And of course, now we're putting pressure on the supply side of the economy, because I think a lot of people will want to withdraw from the formal economy because they feel like it's more at risk personally, and some will self-deport, and some will just feel it's higher risk to be in a formal environment with your social security number. So I think that there will be people that might have been part of that workforce, and then I think we were talking about it at the breakfast you hosted this morning. I do think there's also a risk of losing some of the talent that flows into this country, the people that want to be here feeling less welcome. And so part of the way the US has supported growth for, over a century is the ability to bring great talent in. So I think that the conversation, right now everybody's just focused on the near-term impacts of the tariffs and the things we were talking about. But I do think that there is also an issue around workforce that will make it challenging to build the way the people who would like us to build more want to achieve.
I don't know if folks heard an interesting comment from Ken Griffin yesterday, where he said that a survey was done asking how many Americans would want to bring back manufacturing to the United States, and the answer is 80% of Americans did. When they were asked the same question, how many Americans would want to switch their current jobs to a manufacturing job, and said only 20% would want to shift into that line of work. But one last question, and it may sound quite corporate, but obviously all of this has to do with this incredible complexity, the ripples of change and uncertainty and on supply chains.
Yes.
And I know that you do tons of work there.
Yes.
It's almost like an invisible nerve, kind of nodes of nerve network.
And there's so many interdependencies. And what's interesting about the world economy is, in particular, when you look at the US import-export imbalance, we do have disproportionate power through tariffs versus what others can do to us, because we import so much more than we export. On the other hand, we have remarkable supply chain dependencies on the rest of the world, and particularly on China, because it's so a part of so many of the world's supply chains, and not just as it relates to critical minerals, many other components that go into infrastructure builds, manufacturing builds, consumer products, children's shoes, Halloween costumes, a lot of stuff that we don't even think about go through these. And so I think that the risk of supply shocks coming in, that was part of the discussion earlier, but I hear it all the time. People do not realize how many dependencies there are in the US economy, that if parts suddenly stop shipping, if China were to decide, I'm not asserting that they are, I don't know what they're doing, but beyond critical minerals, to assert their power in different supply chains, the level of risk in this economy, I think, is quite real. And we watched in COVID, for very different reasons, how supply chain shocks impact pricing, impact consumer sentiment, impact just raising and economic activity in general. And that's, to me, The workforce stuff you can kind of see. The impacts of uncertainty you can kind of see. I think the wild card in this is what will happen in some of these critical supply chains that both touch consumers directly, back to school, Halloween, Christmas, and impact all the things that get built in this country, infrastructure, manufacturing, housing. And I think that there are real risks there that I think we're all hoping that things will, there is some optimism this week that the temperature may be lowered on this soon. That would be great. That would be great. And, but that if that doesn't manifest itself, then the risks here are meaningful.
Great. Well, Rich, thank you so much for that very intelligent survey of these important questions. Really appreciate you having you on stage. Please thank Rich Lesser.
Thanks.
Thank you. Good job.
Please welcome Paul Lawrence, President and CEO of Global Wealth and Asset Management at Manulife Financial Corporation, and Gina Chan, Senior Editor at Semaphore.
Thank you so much for joining us. And for those of you in the back, there are some seats up here if you want to take a break. So, Paul, we heard a lot about how businesses are dealing with the economic uncertainties with Rich and Justin. I wanted to get your thoughts about investors and how they are seeing the current landscape. We've seen, maybe a bit of a sense of relief with the president coming down a bit, especially on the Chinese trade front. But are you seeing investors sort of taking a break from participating in the markets just because you don't know what's happening right now?
Yeah, we get a very interesting perspective because we oversee institutional client money, both private and publics, retail clients, and also retirement platforms, 401k equivalent. John Hancock here in the US is part of the wealth business. And so we get different angles of the different segments. I would say in the institutional space, coming into the Q1, we started to see a rotation out of US equity into more international, but that was more just because the US had such a run. Valuations were getting high. We were seeing some of that. You were starting to see money come into fixed income. We had just gone through a rising interest rate cycle. There was an assumption the Fed was going to cut, so money was coming in. That really started to slow at the end of Q1. And in Q2, we've actually started to see some of those institutional investors pause to the point where in our private assets, we've had clients doing due diligence on some of our funds for over a year. The next step is just going to the investment committee for approval. Some of those investment committees have said no net new investments in the US, no exceptions. And that's less about the US as it is about just uncertainty and lack of clarity of what does this actually mean. So we are seeing some of that from different investors. It's not widespread yet. I think the other thing too is within those asset classes, putting that money to work. I think you're going to see a lot of investment teams maybe slow the deployment till they really understand what it could mean there. In retail, we've seen a flight back to safety. With a lot of money in money market, you would have heard that last year here in the US. That's true in Asia too. We've seen that come back to the sidelines. Again, at the end of Q1, Q2, I suspect will be very similar to that, where they're going to safety.
But what does flight to safety mean now? It used to be to treasuries. It used to be, the dollar. That seems to have turned on its head a bit.
I think a lot of it has gone back to cash.
So
a lot of it's cash.
King.
Definitely in a lot of the Asia balance sheets, which aren't as mature as North America, the household balance sheet there is basically bank deposits and real estate typically. And they haven't really gone to the market the same extent here. And a lot of those emerging markets, you can get paid quite handsomely just to sit in bank deposits. And so I think that's safety right now. But you're right, where is safety? You could argue is fixed income safe right now, if you think rates are coming down, but with inflationary pressures, that's kind of pushed off that trade a little bit as well.
Yeah, so what does that mean for the global economy? If they're just pausing, does that have real ramifications, or does it matter how long that duration is of keeping your powder dry?
I think that is the fundamental question. And what markets don't like is uncertainty. Markets, they like direction, regardless of the outcome of which one you want. Once you have it, you can plan accordingly and understand what the right investment choices are. So I think that's what the market's craving right now, is there's still a lack of clarity. I think what you're starting to see is, I think the opportunity from an investment perspective is generally everything gets pulled down in these markets when there's volatility. And so for a business like ours, which is mostly active management, there's tremendous opportunity of really high value companies that are getting pulled down with everything. And this is an opportunity really where you should see some of that value come through. I think the second is just the broad remit of the global platform. If investors are looking to pivot or shift some of that to other markets, maybe diversify a little bit, I think that creates some opportunity too. But I think alternatives is the other one where, regardless of the current environment, you really were starting to see more and more money go into that. Partly because if you don't need the liquidity, you can get paid more. If you don't need liquidity, you can earn more on that. When rates were low, I think it was really interesting asset class. We've seen that translate into the retail space, and even in retirement, where you've got individuals in target date funds for 20, 30 years, they would benefit as well. Yeah. It's going to take a lot longer, I think, for retail and to make its way there, but I don't think that trend is stopping. That's still going to be there for the long term.
Yeah. So if you're patient capital, or have the luxury to be patient, you're possibly in a more advantageous position now.
Yeah, and there's opportunities in markets like this, always in hindsight. If you go back to markets where there's a lot of disruption, that's when typically the biggest opportunities are. So it's just trying to make sure you understand where those bets are and hedging them in some way.
So where are you seeing some of those opportunities? Because we hear a lot about during the financial crisis in 2008, if you made big bets then, they actually paid off very handsomely later. That's when we saw Uber and a lot of the big startups or big tech companies today, really take shape. Where are you seeing those opportunities now?
So I think one, in fixed income, depending on your outlook of whether you think it's a question of timing, but if you do think rates ultimately will have to come down to support, that's generally going to be a good thing for fixed income. And investors have been patient waiting for that trade to happen, whether it happens in the timeline you expect, but I think that could be an opportunity. Definitely on the private asset side, we're seeing a lot of interest in infrastructure, data centers, Gen AI, energy. We're in the market with our team, and there's a lot of interest from investors there. Continues to be. It gets blurred a little bit. You could say real estate, data centers. It crosses asset class a little bit, but generally that demand is not going down, and there's a massive need for capital to support that. So we see opportunity there. Private credit's another one. Companies are going to need money to support their growth. You've got a lot of the banks and everything really scrutinizing credit. Credit's going to be really key through markets like this, and that's an opportunity if you've got a really good credit team. And then the other area we've seen it is that bridge between purely illiquid privates and publics. We acquired a company last April out of London that does liquid alternatives, CQS, and we've seen quite a bit of interest from both institutional and retail investors here in the U.S. for those capabilities that we're starting to package, because they're not completely illiquid, but they're somewhere in between, and it's almost that entry point for those types of investors.
Yeah. And what are the kinds of returns that investors can expect to see on some of these alts, or as you say, AI infrastructure, data centers, Gen AI? Because I think people read all about the hype, and obviously there's a lot of build out, there's a lot of capital being deployed, but even for companies themselves trying to figure out the return on investment on some of that still seems a little blurry.
Yeah, I think, and the way we look at it is it's really around the portfolio, and it's all relative to the risk-free rate. So, and the risk you're willing to take, whether it's liquidity risk, whether it's credit risk, nothing's free. Everyone goes after the big returns, but even in the U.S. market, it's highly concentrated to tech. And do investors really know that it's highly concentrated? Do they really understand that, or are they just chasing returns? So it's really that risk-adjusted consistency of performance, and I think that's how all investors are looking at those asset classes. But a lot of that depends on interest rates. Real estate valuations change as rates change. So just really trying to understand what your outlook is, and then how do you package a portfolio that where you're not placing just one big bet, but you're diversifying that. You're getting the correlation benefits of a portfolio, and at least has the ability to tweak as you move forward.
Yeah. Well, in terms of diversification, Manulife is obviously a global business. You were recently in China. We've heard a lot about the trade war and where that could go or not go. What are you hearing from clients there and investors of how they're kind of gaming out this situation?
Yeah, I think a lot of what we hear is really how will this impact the local markets, and whether it's the local markets and ultimately the local economy, because much of what we do is manage money, domestic capabilities for local investors. There's very little cross-border money going in and out of a lot of those markets, including China, frankly, from foreign investors. And so really it comes down to what could this mean for ultimately the economy, the impact on the consumer. And I'll give you a good example in our retirement business where investors typically don't reallocate. They're putting money in, they're saving. We can see whether that consumer is feeling the impact of the economy, particularly in the US here. We'll see if their withdrawal rates start ticking up, if they have to access those retirement savings pre-retirement because of the cost of food or cost of gas. And so we can get these leading indicators of, okay, is the consumer starting to feel this now? And is it widespread? So when I go to the different markets and meet with government or local, it's all around just trying to understand where this market's going. And like I said, in some of the Asian markets, you could get paid 8% on a government bond to sit on the sidelines. And so as an asset manager,
nice.
if you're trying to compete with that, why come in? So you still have a lot of cash sitting there. I think the fundamental opportunity in a lot of those emerging markets is they don't have a retirement, what we call Pillar 3, which is the equivalent of the 401k here. It's the defined contribution in Canada. And the government can't afford to fund the massive populations there. So they need help. They need help in the infrastructure, the tax incentives, but they also are looking for a lot of help for companies like ours that have a leading presence here in the US and Canada and Hong Kong and Indonesia around how do we do this? What's the right framework? Because they have to solve it at some point, and they need to create that incentive to move money from cash or bank deposits into the market and longer-term investing, and I think it's going to take some time.
Yeah, and so are you seeing any indicators yet of how consumers are feeling this, or is it too early?
I think you're seeing the same thing we're seeing here with money go to safety. We saw the same thing in a lot of those markets in Asia. Go back to money market funds, back into bank deposits. And you have to remember it's a little different. Here in North America, markets have been quite strong for a number of years before the recent volatility. That was not true in some of the markets, particularly in emerging markets in Asia. And so when your balance sheet is real estate, which has been hit hard in a lot of the areas in Asia, and then the rest you put in the market, you've been penalized there, you've kind of lost a little confidence, and you just go back to the cash at the bank deposit, which is safe. And so there is just this confidence question of when will consumers want to come back into the market there.
Yeah. And what about India? Because that's seen, on a corporate supply chain perspective as a hedge against China. And, they were hit with the recent U.S. tariffs, but not as hard as some other countries. What does it look like from an investor perspective?
Yeah, so we've been quite bullish on India just from an opportunity perspective. We don't have a big business there. We have a joint venture there with Mahindra, a mutual fund company that has grown quite a bit since we formed our partnership there. But I do think they're putting a lot of the infrastructure in place and the framework to really allow the industry to really move with speed for those. Again, there you've got a lot of, it's not as mature yet in certain areas. So there's a lot of rural areas in India that don't even know what a mutual fund is or an ETF or how to invest. So it'll take some time. But I do think there's a lot of infrastructure going in. And again, you're looking at that market not for the next 5 years, you're looking for the next 10 and 15 years. But it is a market we think has tremendous growth potential.
Yeah. Well, and in our last seconds here, I wanted to just ask you about Manulife's own growth, and particularly inorganic in terms of M&A, a subject near and dear to my heart as a former M&A reporter. What are you seeing in terms of opportunities? You mentioned private credit. We've seen a lot of M&A, particularly on the insurance front on that side. Are there things particularly with valuations where you're looking to buy?
Yeah, I would say generally the activity's quite strong in the market for a number of reasons. One is there's a ton of pressure on active managers and passive, which you hear about all the time. But you also need scale. You need scale to compete, and everyone's trying to understand where's the growth story. For us, we've been quite fortunate. We've had At the end of last year, we had 14 of the last 15 years, we were net flow positive of money coming in versus a lot of our peers that are really struggling. And part of that's the diversification, part of its capabilities. One thing we've been doing is trying to make sure that as we look at our platform, where are the markets where we think we should be based on our skill set, where we can add value for the end investor. India is a good example, where we went into India. That's been driving positive top line for us, knowing it's a longer term. And then where are there capabilities we don't have? CQS is a good example, liquid alts manager. They only sold to institutional, mostly in London, Europe. We have a global footprint with institutional, and these are capabilities that we could see working their way into retail investors and the like side, and retirement. So for us, we're actually optimistic to look at where are those other opportunities for us that we could look at that. Alternatives definitely is one, where we know we want to be much bigger in that space. We have about 100 billion Canadian that we manage today. We've got teams that have been managing for 30, 40 years, and a lot of it for the insurance company, so they have a track record. But the more we could scale, more capabilities, more distribution relationships is big. And then in Asia, where we can add scale to certain markets that we think long-term would be attractive. And then anywhere there's capabilities that we think investors are looking for. The one theme I didn't talk about is just this desire and need for income. Income. So any capability that you can plug into that, whether it's liquid alts, whether it's fixed income, whether it's dividend-paying stocks, creating income solutions for investors seems to be a theme, particularly across the Asian markets. That's not going away anytime soon.
Yeah. Okay. Well, if there's any scoops you want to pass along my way about what you're going to buy, let me know.
Sounds good. Will do.
Thank you so much.
Great. Thanks.
Take care.
Please welcome Harvey Schwartz, CEO of Carlyle Group, and Liz Hoffman, Business and Finance Editor at Semaphore.
Hi, Harvey.
Hey, Liz.
Thank you for coming.
Good morning, everyone. Great to be here.
So, you've been around a lot of cycles. Does this feel like 2020, 2008, 2000, 94? I do believe you started your career on Wall Street like just before the crash of '87.
Sort of the same day, actually, as a kid.
Okay.
Yeah, it was a nice introduction to the world of finance and economics. I think in all those periods, whether it's 87, 94, 2000, 2008, the pandemic, there are shadows of history that appear in each one of those. I do think there are elements of that here in terms of people's focus on markets, function, all those issues, they feel similar. I do think this is different in many respects, just like the pandemic was uniquely different than 2008. But it's different because it's a policy shift globally, which I don't think people should have been as surprised as they were. It was sort of well advertised, but even if you go back a couple of years, you could feel the trends of globalization were pulling back. And now you're seeing policy initiatives that are driving a different agenda. And I think in that sense, it's different because policy has a landing place. And what the market is seeking now is just really where's the policy headed and what are the ultimate rules set. So in that sense, it's not as severe as a 2008 or a 2000. It just has similarities and feels different.
You invest in all kinds of industries all over the world. Just level set, like 3 weeks out from Liberation Day. How is this going?
So at Carlyle, for those who don't know, we're $450 billion of assets across real estate, private equity, infrastructure, credit, insurance, secondaries, and co-invest. And so the firm is quite diversified as we're really micro investors. So as micro investors, we're in the business of businesses. And so each one of our teams, every single individual, under any policy regime, but under this shift, really is first and foremost thinking about what's the implication for an individual company? How do you think about the opportunity set? Because in some respects, this can be a very unique time to deploy capital in the world. How do you interpret the various possible scenarios and outcomes? And how do you think about your portfolio construction going forward? But we have businesses all over the world. We took three of the largest IPOs done last year, one in the United States, one in Japan, one in India. And so this has global implications for how to think about capital deployment. So on the one hand, you want to make sure that you're very, very finely attuned to the risks associated with policy change, whatever policy change that may be. On the other hand, you want to be keenly looking for opportunities because the demand for capital will inevitably go up.
Do you think this has all made America less investable?
I think coming into this year, when I was traveling around the world in 2023 and 24, pretty much everyone I would meet with, from sovereign wealth fund to pension, anywhere in the world, they would say we're over-allocated to the United States, but we're looking to allocate more. It's very difficult not to allocate capital to the United States. The history of rule of law, the performance of companies, the dynamism of how CEOs manage their businesses. So I don't think at this stage anyone is saying, oh, after a month, that trend is going to pivot so quickly. I think what people are saying is, what are the policy initiatives, really, where do they land? Where does this ultimately end up in terms of the geopolitical fabric of trade and geopolitical economics, such that where is the greatest opportunity to deploy capital? And some of this has been in motion well before the Liberation Day. The big trends that have been dominating sort of like the macro policies around the world were pretty visible. You know, if you think about how national security for all countries became a dominant thematic after Russia went into the Ukraine. National security, energy security, data security. These were thematics that were in place long before the tariffs. And so they were going to drive capital allocation around the world long before this. Now capital allocators around the world just want to know, what's the rule set? And once we get to the rule set and we get through this period, I think you'll see a lot of capital get put to work around the world because those thematics aren't changing. They're the underpinnings of what may drive activity for the next 5, 10, 15 years.
Carlyle's roots are in Washington, really in the defense sector.
Yeah.
Our
headquarters is here.
Yes, down the street. But a lot of money coming into that. A lot of countries around the world are rearming. I mean, obvious question, is it good for your business? But kind of what do you make of a lot of money going into militarization?
Yeah, so let's be clear. We don't sit around Carlyle rooting for rearmament.
Your long war?
Yeah, it's not something that anybody cheers for. And so what we root for is peace and global growth. And it'd be great to see peace around the world. I think, though, that there are times in any cycle where certain themes dominate. We went through a very long period where the primary driver of capital allocation around the world was driven by efficiency. Supply chain management. Every company in the world was looking to be as efficient as they could, and that was basically broke down political borders. And in that period of growth, many great things happened around the world. Billions of people came out of poverty. Then you saw basically priorities start to shift. And whether you want to call it nationalism or onshoring or prioritizing defense over other political objectives, I think these are just things that happen with time. And so, again, as capital allocators, we look for areas where we have deep expertise. One of the first transactions you mentioned is we ever did when the founders, David, Bill, and Dan, formed this firm in DC in 1987, was in government services. And so, yeah, we have deep, deep thought leadership in that space. That doesn't mean weapons. That has to do a lot with supporting governments, supplying resources, working with contractors, and really understanding the essence of the geopolitical fabric that helps drive business value creation.
But to your point, the people running businesses and big investment firms these days were trained in a world where they got more and more and more efficient. Do they know how to run like slightly pudgy companies? Is that a skill set that this group has?
Slightly what?
Pudgy, I think is the word I use. But like with a little extra cushion baked in, where they're not trying to squeeze the nickel as hard as humanly possible?
Yeah. I was just trying to respond to pudgy. I didn't know if there was a personal thing. I think, because I'm feeling a little pudgy lately. I think probably too many carbs or something, not enough Ozempic.
It's a very stressful time.
Yeah, I'm like the last person in the world that's going to have a weight problem because I'm not on a GLP-1 inhibitor. Not judging. You'd be on them. It's all good. It's all good. Better for the cholesterol. I think that, I think this is a really important point. I actually think that the optimization of efficiency and then the optimization that occurred during the pandemic actually is the opposite. I don't think it's about running pudgier. I think it's about they're actually quite trained. So let's just take price and inflation. Going into the pandemic, before we had the supply chain shock, most companies around the world didn't even know how to manage price elasticity. They didn't know they had pricing power. So we had companies that had $1 input items that all of a sudden went to $2. Like headline inflation might have been 7, 8, 9%. We had companies that were experiencing 100% inflation. We could see it when we roll up the data. So we roll up all this proprietary data. We have 2,300 employees at Carlyle. We have 700 plus thousand in our portfolio companies. So we roll up all this proprietary data. We could see it where we could see prices go up, we could see prices come down, we could see the management teams learn how to manage price. And so these are management teams and businesses all around the world that actually understand price elasticity. And so if there's pricing pressure, they will translate price. They understand how to measure marginal demand, and price will generally go up until you see demand destruction at the margin, and then it'll modulate back. So I actually think companies are really well positioned to be dynamic. Now, having said that, it's really a question of how long this period of uncertainty around the rule set persists, because the challenge for that is, how do you make decisions? How much inventory do you buy? How do you think about pricing decisions? How do you think about the competitive nature of pricing decisions? And when you sit with your management teams, how do you think about deploying resources? So what management teams really want and what businesses want, by the way, big businesses like we own at Carlyle and small businesses all around the world, what they want is a rule set so they can optimize the rule set. Optimizing to the rule set is not a bad thing. It doesn't mean breaking a rule or a loophole. It just means operating their businesses as efficiently as possible. So I think they'll do that, pudginess aside.
But you're buying companies in your private equity business for 5, 7, 10 years. You are essentially modeling how much money you think they're going to make in the future and figuring out what they're worth today. And it just seems to me that math is incredibly hard right now. Are you having trouble deploying capital?
No, so the public markets are telling you there's uncertainty, right? So uncertainty correlates with volatility, and volatility reinforces uncertainty, and we're seeing periods of that. And obviously, it's an exceptionally news-sensitive, headline-sensitive environment, which is zigging and zagging markets. That doesn't lead to not wanting to deploy capital. That leads to a repricing of capital. So if you see multiples come down in public markets, you'll see we will incorporate that risk into our algorithm and how we think about deploying capital. But really, when we're buying companies, what are we looking for? We're looking for unique businesses with differentiated management teams where we feel they can be competitive over a long period of time, and they have a market positioning that we can help them build and grow the business. And that could take on a whole bunch of forms. It could be a carve-out of a company that really wasn't allowed to grow because it was embedded in a bigger organization. It could be an opportunity where we think we could roll up an industry and create lots of scale and growth. And so what we do in an environment like this, not unlike what the public markets are doing, is we price for the incremental risk premium. And that will lead to, overall, a reduced transaction volume, I think, in the public markets for sure, and maybe for a period of time across the private markets, because the bid offer between what people want to sell things for and what private capital is going to deploy is going to be sticky for a little bit because of this uncertainty premium and because this has all happened quite quickly. So I think as we get through this, though, I think there'll be really, truly unique opportunities to deploy capital. Now, for private markets, I think if you wanted to attach yourself to a base case going forward, if I asked for a show of hands and I said, and we're not going to do this, if I said, how many people think Europe is going to want to deploy more capital into Europe, Japan into Japan, Middle East into the Middle East, Canada into Canada, the US into the US, I think everyone would say all the signals look like politically, from a geographic perspective, Latin America, you're going to see demands for capital only increase over the next 10, 20 years. Where is that capital going to come from? It's going to be difficult for sovereigns to take on much more debt. Bank capital is constrained. Private capital is going to be the marginal provider of that capital. I feel very confident of this. Over the next 10 or 20 years, private capital will continue to grow because the demand for private capital will go up. You can see it. And so I feel really confident about the ability for the industry to provide really valuable capital at the margin, whether it's in private equity, infrastructure, real estate. You pick your sector. There's demands at the margin for capital under any scenario you can conceive of.
Really quickly, you are a risk guy at heart. This started in stocks, then it went to bonds. We've seen the dollar sell off.
Better than pudgy guy, okay?
but you know, and for many years you ran a $1 trillion balance sheet at Goldman Sachs. Yeah. When you are hunting for the tail risk here, what spring might fly loose, down the road that we didn't quite see coming? What worries you?
Yeah. Well, the whole thing about the hidden risk is that it's hidden, which makes the question tricky. I think that, in all those periods that we mentioned before, from '87 through to the pandemic, sort of the common things you want to look for are concentration of asset risk, weak liability structures where the liability structure doesn't match the asset, and interconnectivity. You lose one bank, it's not a problem. You lose 10 banks, it's a real problem. And so, in post-2008, when you look at the global regulatory reform and all the work was done, I think the system has demonstrated it's very robust. I think in all these market scenarios, obviously you get a huge amount of focus on the equity market because it's sort of the first to indicate to us a repricing of assets and an increase in uncertainty, or vice versa, a repricing up and an increase in certainty. I think ultimately it gets to the global plumbing and global bond markets and the behavior of global bond markets, because that is really the infrastructure that allows markets ultimately to function. And so I think there's a lot been written on this recently about the correlation between the dollar, bonds, and equity markets, and I think that is certainly worth noting, because that correlation is somewhat fundamental to how sovereigns around the world think about their own allocation of capital. But I think that, again, it's going to, it's hard to find the canary in the coal mine until the canary pops its head out. But I think that the things I'd be looking for are highly levered situations with poor capital structures.
Well, when it starts singing, we'll have you back to talk about it. Thank you so much, Harvey.
Everyone, thanks so much. Great to be here. Congrats on a great conference.
Please welcome Greg Fleming, President and CEO of Rockefeller Capital Management, Jenny Johnson, CEO of Franklin Templeton, and Liz Hoffman, Business and Finance Editor at Semaphore.
Oh, it's not over there in the other room. Sorry.
It's the moment.
Morning, Liz.
Yes. A lot going on in the world. Start very broad. You both, sit at the intersection of major money flows, major investor sentiment. You're all over the world. And that's just for a 30-second level set from both of you on what you have made of the last, call it, 17 days, 18 days?
Wow, feels like longer than 17 days. We work with clients on a long-term basis, and we have in place plans that factor in periods of market volatility. So our clients, we spend a lot of time talking to them about stay steady, let's stick with the long-term plan. Are there pivots we want to make based upon opportunities that might arise in the market because of sell-offs or things like that? But our message is stay steady and stay calm. What they're looking for, which everybody's looking for, is some stability, some predictability, having all this settle in a little bit. But for us, in short periods like this, we're very focused on making sure the clients stick with the long-term plan and don't react to a market that literally can change by the day, which has happened in the last 17 days many times.
Jenny, is this a set it and forget it environment?
Absolutely. I mean, and what has probably surprised us a little bit And Franklin Templeton is sold through firms like Rockefeller, so usually there's a financial advisor there. But a lot of times that channel will react to these kind of volatility, and it's, and they'll panic when the markets drop. And we've actually seen them be pretty steady, and I think that's the good news. On the institutional side, you saw in certain places, I do think the Europeans have reduced a little bit of exposure to U.S. equities. We've seen that a little bit on the institutional side. I don't think that's a long-term sort of play.
Is that an emotional play, or is it their portfolios got a little out of whack?
Well, I think the European index has been the best performer of the, so far year to date. So it may have had something to do with that. But if you hadn't positioned your portfolio, there's no point in making the changes now, right? Because you really, if you're in cash, you're probably staying in cash for a while. If you're already in the market and you hadn't moved to more defensive sectors, there's no point in doing that now, because at some point you're going to see, look, the technological innovation that's happening is still very real, and those are going to come back.
Can I just make 2 points in terms of the long term versus the near term? One, retail investors in the U.S. have continued to buy on most of these dips. And the second thing is, in terms of like European investors, you had 70% of global market capitalization was U.S., I think, at the end of 2024. There was going to be some adjustment to that, and there was going to be investment in places outside the U.S. before all of this. There was no question there had to be some balancing on that. So some of those institutional investors may have had that in place, as Jenny said, before this.
Are you surprised that it's Europe, though? I mean, the Gulf is interesting. Japan has a lot of tailwinds. Europe, it's had a tough couple of years. Does this have legs?
We'll see. I mean, it has had a tough couple of years, and but it is a 350 million person marketplace. It's a huge economy, and there are signs that it might be different this time in places like Germany. So we're going to find out.
Well, and I think on that, the joke was, is it MAGA or MEGA? Is it make Europe great again? It is a wake-up call for Europe a bit, right? The U.S. is saying we're not necessarily going to continue to cover you on defense. They've seen what's happened on on being so reliant on others for energy. And if you think about Europe, why haven't there been more tech unicorns there? There's obviously brilliant people, and a lot of that, I think, is the dynamics of the regulation and just kind of the environment. And so if this is a bit of a wake-up call where Europe says, we can't rely on the U.S., so we've got to work together to figure out a better plan here so we can be a little bit more self-reliant, I actually think that's a really good thing.
Do you think it's the regulation, or is it the capital? And I ask because is there a moment now where Harvey was just on saying
it's a lot of things.
Is there going to be more pressure for German pension funds to buy German stocks, for Canadians to buy Canadians? Is there a way to get more of a domestic capital market going in Europe, just frankly out of spite?
Spite is a hard thing for investors to follow because investors are trying to make a return on the money. So, one of the things that I think is going to be clear as things settle here is that investing is going to remain global. I mean, Franklin's got a global footprint from an investment standpoint, and investors are going to follow wherever they think they can maximize yield. So you might be able to try to create more of a dynamic financial market in some of these countries and maybe across the European Union, because that is one of, as Jenny said, this country's greatest strengths. The innovation process, the entrepreneurial process, the capital formation, the capital getting into the right companies' hands. Some of these, these huge companies that we spend so much time talking about, 15 or 20 years ago, these were startups. This country does that really well. Whether the Europeans, individual countries, or across the European Union, they can set in place events to make that happen. We're going to find that out.
You mentioned that retail has bought a lot of these dips. Is that a good thing? Like, we obviously want retail invested in the market, but what do the institutions know that individual investors don't, and are they just catching the knife at this point?
Well, I think one of the things the markets are telling us day after day is that nobody really knows. Where is it going to settle here? Yeah. There's obviously a lot going on the tariff front. So how much our institutional investors are privy to something that retail investors aren't. I think that retail investors have done so well investing in the dynamic American economy that it pulls them back in. And I remain upbeat, as I'm sure Jenny does, on where this country is going. Jenny was starting to go to technology and artificial intelligence and the impact of that on productivity here. So if we can get some settling and some steadying in the marketplace, I think those retail investors could still be rewarded.
Are you starting to see, the concern, I think, is that when things fall in the stock market, people feel poorer, and then it becomes a real economy problem. And I'm curious, you guys look at sort of your customer balances. Is the wealth effect, are we in the middle of that and we haven't quite felt it in the real economy?
So I'm going to answer the risk slightly differently, right? And again, the economy and the market are two different things, right? They're tied, but they're two different things. And so, if you look at where we are today, you have to remember, so Trump has said, I care about tariffs, immigration, taxes, government efficiency, and deregulation, right? He's kind of laid those things out. And actually, he's been pretty dang deliberate since he's gone in. He's, trying to address them. And if you look at where he is on tariffs, let's face it, if you're going to negotiate, right, he's a deal guy, you're going to negotiate, you want to demonstrate that you're negotiating from a position of strength. So you do it, and I laugh because somebody told me to look at like Worldwide Poker and watch how some of these people do it, and they'll be like, oh, that's a boy bet, flipping the chips, right? It's a distraction. So there's an element of this that's part of his way of negotiating a deal. Now, he also, to get his tax, and we call it tax cuts, but the reality is there will be a massive tax increase in this country if the tax cuts are not extended. There'll be some additional tax cuts, but just think about if that isn't extended, how big of an issue that is from the economic standpoint. So to get those, he needs to be able to demonstrate that he has either generated revenue or cut expenses in the order of somewhere between $2 and $4+ trillion. So if you're actually thinking in terms of your broader framework, you have to think, okay, he says this is a $600 billion revenue benefit with these tariffs. You don't want to negotiate too many deals because when you have to get your tax cuts done, you need to be able to say it's $600 billion. Now, we'll see what the CBO says, but that's an important part of his story, right? But the risk, so that you're asking about the risk is you talk to CEOs, one is they can't provide guidance, or if they provide guidance, there's so many caveats to it that everybody realizes, all right, I don't know what that means. Number two, anytime there's uncertainty, you stop making capital expenditures. And so when businesses, start to hesitate on that because they need to be in a wait and see mode, that's going to become an issue for the economy. And then the final thing is the unintended consequences. The fact that, our customs system can't handle the tariffs actually being inputted, so there's a potential of packages being stuck at the ports and shelves being empty. That all becomes a self-fulfilling prophecy of risk. And so he's got a window where he is trying to balance kind of the trade agreements with ultimately, I think, the tax cuts. And it's threading a very fine needle.
Greg, were you heartened by, there was all this talk of, is there a Trump put, right? Is there a pain point at which he's going to back off? Ultimately, I think the strike price was perhaps a bit lower than people had thought. But are you heartened by the fact that there was a feedback loop, that actually the one thing that the president has been sort of unable to fully bully and knuckle over has been the market? Is that heartening to people? Do you get the sense someone's listening?
Well, that's one of the things I've been saying a lot recently, which is the markets have been as clear on an immediate basis as I've seen in my career, which is now 37 years. So the market messaging around different steps has been a break and clearly has had a real impact on some of the near-term decisions here. But one thing, Liz, I wanted to come back to that Jenny was talking about that's a really key piece of where we are going forward is this budget deficit. And when Scott Bessent was first confirmed as Treasury Secretary, he was talking about 3, 3, and 3. We would get to 3% inflation, which looks like it's not going to be a problem. The issue is keeping it there. 3% real growth, which would be wonderful to see. Technology and AI may have a part in that. But then a 3% budget deficit. Before all of what's happened with tariffs, the big issue for this country, and it was already impacting us in terms of things like dollar and treasury yields, is the fact that we were running a budget deficit of 6 to 7% in a positive economic time. Over the last 5 years, just one statistic and I'll stop. From 1945 until today, receipts as a percentage of GDP were about 17% a year, and spending was 19% a year. So there was a gap. We had, obviously, when Bill Clinton left office, to remind everybody, there was a budget surplus, but there's a 2% gap. In the 5 years, 2019 to 2024, receipts as a percentage of GDP were 17%, and spending was 27%. That was unsustainable coming into, we obviously have a new administration, but whoever took office last November had to and still has to deal with that. So that's in front of us here.
And the backdrop of that, what's allowed us to do that is people have been willing to buy our debt for a really long time. And we've seen some, I'm curious whether you think this was just a little bit of a temper tantrum or whether there has been sort of a reset in how creditworthy people think the United States government is. Jenny, what do you think?
Look, I think, you have people speculating like, will the U.S. be the reserve currency? Is that at risk? No, it's not at risk because there's nowhere else to go, right? I think the question, and as Greg pointed out in the debt, so we went from 2007, 9 trillion to now like 33 trillion, right? Guess what? We got to fund it, and something like 70% of it turns over in 5 years, and so you have to attract. It's still risk-free. I don't think people are thinking there's a better option, and so, but at what price will you choose to buy treasuries versus something else? And as you have grown the deficit, you just need more buyers to be able to do that, and that crowds out other investment.
One of the things I'll say here is that people's willingness to buy treasuries in very difficult times throughout history, very difficult times around the world, people buying treasuries throughout the world, is tied to the stability, the predictability, the reliability of the United States. And that's one of the things we have to keep in mind as we're going through these times where there's a lot of policy change. We want the rest of the world to still look at us as the economic superpower, and they can rely on us doing things going forward the way that we have for so many years historically, including rule of law, the way the financial markets work, and we need to be careful with anything that provides a real taint on that.
But the safe haven asset over the last 2 weeks has been gold.
Yeah.
Like that doesn't seem like a good sign of anything, no? I mean,
Well,
what do you make of that?
First of all, I say it's 2 weeks, because I'm with Jenny. I get this question on reserve currency, and I say, okay, so what are the options? And that was true again. There's been discussion about reserve currency status back to Russia when they went into Ukraine, and so many of their assets were frozen around the world. People say, well, wait a minute, America's overreached. And the
concern is that if you weaponize the dollar.
Exactly.
Right,
so that's now been around for a number of years. This is still by far the biggest and strongest and most dynamic economy in the world. So I don't see the dollar at risk as the reserve currency. But I do make the point around the perception of us as reliable, steady. They do things a certain way. You can count on them to do it that way in 10, in 20, and 30 years. And we need to be careful with that.
Let's spend the remaining time we have left talking about private markets a little bit, which is, this is the first crisis where you've had a real alternative to public markets, a lot of money there. I'm curious, we haven't quite seen the earnings come out yet, but you look at some of these and firms that invest in both sides, their public portfolios are down 10 or 15%, but lo and behold, the private markets are exactly where we left them in December. And Jenny, Franklin Templeton has leaned into this business. Is this exactly a proof of concept? The private markets are supposed to be a little insulated from the gyrations of the public market, or is this just head in the sand stuff?
No, I mean, I have this debate internally too. The reality is, it is permanent capital that backs those, right? So the good news is, I mean, if you think about a pension fund let's just take 2022 when fixed income and equities both dropped, their assets in the private markets actually had a premium because your ATM to pay your pensioners had to come from all your liquid. So actually in times of stress, there is actually a premium value to the fact that it's permanent capital. Now, I always say, well, so what is the mark to market? Well, they don't mark to market in the same way. I think they say that private equity, it takes about 6 months for it to mark, and it marks about half of what the equity markets are down. But there is the reality of what happens in overselling because something is liquid in times of stress.
You still see a lot of appetite among your clients?
Tremendous appetite. Our client base is high net worth and ultra high net worth, primarily American families. And if you have the wealth to be able to invest in privates and deal with the illiquidity, the fact that it's a longer term investment, you should have a significant percentage of your wealth diversified across a range of different privates.
We'll check back in 6 months for those marks. I'm very curious. Thank you both so much.
You're welcome, Liz.
Thank you.
Good to see you.
Please welcome Beth Ford, CEO of Land O'Lakes, and Liz Hoffman, Business and Finance Editor at Semaphore.
Beth, thank you for joining us.
Thanks for the invitation.
You have, I think, a unique perspective on all of this. As people don't know, Land O'Lakes is a cooperative owned by your members who are mostly farmers.
Farmers and rural retailers.
Farmers are, I think, part of the sort of political constituency that this administration talks a lot about and sort of wants to see a renaissance and a strengthening of the American heartland. But tariffs are just gonna hurt them a lot. So I'm curious kind of what you're hearing from your members, what they're asking for from you as a public figure. What's the ask in Washington? How do you think about an industry that should sort of be a beneficiary here, but is just getting yanked around?
Well, listen, there are so many things packed in that. What am I hearing from the farmer, and what do we see, and what are the implications of these tariffs? So first of all, I would say they're in planting season right now. Growers are out in the field. And we're a dairy cooperative, so producers, cattle, we have cattle, we have dairy producers, and then growers. A lot of folks know our business for our dairy portfolio, but we are actually more significantly indexed to growers. 25% of the farmers, half the harvested acres, we have exposure to. So what do we see? The inputs are in the country. My concern is 2026. We already have an elevated cost basis. Growers are underwater already, especially on the soybean side. The corn, maybe they're more break even. This is the third year in a row where there's been weakness in commodity prices. And so we're seeing a weakening position from the farmer. Now the tariffs, we have positioned our job and our responsibility. Our business is performing well, doing the things it should do, make sure that there's inputs that go to the local retailer that works with the farmer. All of those things are in position for the growing season, but the issue is going to be export markets. 1 row out of 3 for corn, 1 out of 4 for beans. 18% of dairy are exported, and it is important for the profitability of the American farmer. So this trade issue is significant. What we saw, and something to keep in mind, is during the last administration, during the first Trump administration, when there was this, I guess, I don't want to say conflict, but trade conflict with China, what you saw was the rise of Brazil. Brazil is outproducing us in terms of soybeans. Soybeans are used to feed the hog population. Half the hog population in the world is in China. And pork is critical for China. China has also started to increase their own production, self-sufficiency. So they're probably 95% self-sufficient. The one gap they have is really in beans to feed the hog population. And Brazil is their key market or their key partner in this endeavor now. In 2017, both Brazil and the United States planted, say, 90 million acres of soybeans. Since then, they've increased production another 30 million acres. This isn't destruction of the Amazon. They could bring on another 90 to 100 million acres just in pasture land. They've had a weaker currency, so their position is stronger as an export partner. So my concern is 26. What's going to happen? What market access is available to us depending on what the trade arrangements are? And then what about the long tail issues associated with the implications of not having export markets? Right now, one of our key export market, for instance, for corn is Mexico. So you can understand these trade arrangements are critical for the profitability of the American farmer. Now, part of this right now, we are seeing a weakening position at farm level. Consolidation has been occurring. There's only 1.8 million farmers. Half of them were profitable last year. They are underwater right now on their break-evens. And so commodity prices have declined over the last 3 years, but you know what? Cost basis has been elevated. It has remained elevated. When I'm with farmers, what do they say to me? What about trade tariffs? Listen, they want to support the president. I always think of the resilience of the American farmer. You know, 19% of the population lives in rural America. They comprise 48% of the military. They are willing to invest in this country. It is in all of our best interest to invest in these rural communities and in the farmer for the stability of our food system. And they want to be supportive. This is who they are. They invest in this country. And at the same time, there's real concern. The first thing they talk to me about is labor, immigration, the lack of available labor for their farms.
What percent of farm laborers?
Probably half are immigrants. And this is not because they haven't raised wages, et cetera. This is not that. This is normally, these are jobs that are hard to fill, that you don't see a lot of American citizens saying, I'm going to sign up for that hard work.
But how do you get that message to the administration? Because these are classic, you know, they're trying to bring back jobs that it's not clear that a lot of Americans want to do, or in certain manufacturing cases are skilled, you know, have the right skills to do.
You know, I hear from the administration and have heard more recently a willingness and understanding of this. So I don't want to say they don't understand this. And by the way, a bipartisan bill passed on farm workers passed the House twice, just never has gotten Senate and then signed in terms of a bill. So they're aware of this. There's not an office I go into, there's not a place I go into in the administration where they are not aware of this and recognize this. I recently heard the Ag Secretary mention a concern and a willingness to do something, but there's always, the devil's always in the detail. You know, a touchback provision, what does that mean? Visa access, what does that mean? Who's responsible? We have not heard anything specific about what they're going to do from a labor perspective, from immigration perspective. But I will tell you, the emotion gets strongest from them when it comes to this particular topic, because these are folks who have worked with these families. And I think of this, my responsibility, yes, is the business, but it's really about their families, their communities, their businesses. That's the cooperative model, but it's so critical to the stabilization of the food system and the recognition that for a dairy farmer, for instance, is 24/7, 365. And they need somebody with them, a partner with them, labor with them, to take care of this. You know, 3 o'clock in the morning, the pump in the manure pit is broken. They have to be out there fixing this. This is the hard work, and they do it with joy. They do it and believe in their responsibility. And so what needs to be recognized is the necessity that they have labor available, and immigration reform broadly is critical.
I mean, the Europeans have done very well just like driving the tractors through Brussels. Like, this is a pretty, but I know this is a pretty politically sympathetic group of people. If you have farmers testifying on the Hill that they can't buy their seeds, like that feels like a pretty visceral feedback loop to me. How do you close?
Yeah, well, first of all, I want to be very clear. There is support for border security. It starts with that, a recognition of that. a desire for border security. And I think the administration has made this clear that they want to start and prioritize border security, want to make sure funding is available, and they're meeting this requirement. So I think that starts with that. And then can a productive discussion really occur about broad immigration reform? And in addition to my role here, I do sit on the Business Roundtable's Board of Directors and am chairing the Immigration Committee. And I would say broadly, immigration reform is necessary for the amount of workers that are going to need to be necessary to build the economy over the long term. Similarly to my comment on the farmer and the understanding of the desire for border security as a primary, and that's certainly what the administration has been focused on. As well, that is the case for most CEOs that are involved in this particular committee and most CEOs at the Business Roundtable. But there is an absolute desire for immigration reform, the need for workers, for laborers. Who's putting the shingles on the house? What about construction? What about nurses? All of the things, the trades that help us build this economy. And I think that is a critical opportunity area for us.
A lot of rural Americans rely very heavily on public services, on government services that are on the chopping block right now. Curious, what you make of DOGE. And our previous guests were on kind of saying that we do have a deficit problem, right? So we have to either raise more revenue or cut spending. But understanding that a lot of your members are going to be pretty affected by, some of it's unclear whether you can get these numbers without touching the entitlements that really matter a lot, particularly Medicaid, I think, for you.
Yeah, Medicaid is a real concern. The number of rural hospitals that shut down are just extensive. So again, what are some of the things that folks talk to me about when I'm with our members, with our farmers in these communities is healthcare access. Of course, all the things we all want: good healthcare for our families, education, housing, all of those things. Food insecurity, by the way, in rural America, 90% of counties in America that index of food insecure are in rural America. The very people who are doing the work to feed all of us. Food insecurity, significant issue. Healthcare access, a tremendous issue with a number of rural hospitals shutting down. Medicaid access is critical for a number of these families. So that is a watch out. I think, to your point, entitlement programs, things like this need to be reviewed, but a recognition that, again, healthcare availability in these communities is a significant issue. And what will that imply? A lot of the rural population access Medicaid and then Medicare when they're 65 or older, and they do both. And I said, well, why is that? And that is because Medicaid provides some access to funding for nursing homes. Now, the alternative here, and the other point I'd make, is that, for instance, 99 nursing homes shut down in Iowa last year, and they were all in rural areas. So it's about access. Again, what are the investments we're making that is for all of us? It is not just for these rural communities. It is for the vibrancy of these communities, their ability to continue to do the work to feed all of us. And again, reminder, these are the folks who are investing in America with their service, through and have always throughout time.
One thing we've seen, I think, is a lot of industries kind of repackage or reframe themselves as national security imperatives. And obviously, like, there's an argument to be made, like you said, for food security. We should grow more we should support farmers, should grow more. Is that a package that kind of works right now?
Well, I was up on the Hill and was with the last couple of administrations talking about this, that we don't have a farm bill right now. We need support programs, we need safety net programs, but I would wish for them, for instance, to pull ag research funding out and put it into national defense spending. Something to understand, 70 to 80% of patents in the food space have come from China. China's spending on ag research is more than the US, India, and Brazil combined. They're investing in their food system. They wanted food security. That's what they're focused on. Ag research spending for the United States at 1970s level. This will have, again, a long-term implication. Population growth demands production growth, and technology and the use of new seeds, drought-tolerant seeds, those types of things are critical for us to continue to increase production. So this discussion, yay, that's exactly what I said. We should think of this as national security spending. It is in our best interest. And so where is this being made up? Well, think about it. Consolidation occurred at the basics level. Bayer purchased Monsanto, because you say, well, what's going on with private industry? Bayer purchased Monsanto. ChemChina purchased Syngenta. So basically we have one basic in the country. And so then you go to land-grant universities, and their research funding is being cut. Again, we have to think about it in the mid and long term. These things aren't immediate. You don't come up with a new basic R&D and say, boy, we're going to be able to turn this thing around right away. This is a 10-year, 20-year problem. When droughts and weather issues are significant. Water demand, and ag is a huge user of water, is set to outstrip supply by 2030, by 40 to 50%. We need drought-tolerant seeds. We need different practices, and that's the kind of funding that is necessary and should be focused on with ag research.
Everything is national security now.
I think so.
Well, listen, thank you so much for the time, Beth.
Thank you.
Please welcome Penny Pritzker, founder of PSP Partners and former U.S. Commerce Secretary, and Liz Hoffman, business and finance editor at Semaphore.
Penny.
Hello.
Good to see you.
Great to be here.
So you were Commerce Secretary.
Yes.
How do you think Howard's doing?
Well, I think he's facing a challenging situation. I think this tariff policy is really, honestly, I don't get the strategy. I don't think there's a clear plan or strategy, and I think that's a real challenge, and it's having an effect, as you see, on business. I think it's going to affect job creation. I think it's going to affect inflation. And I don't get it, honestly. I don't really get it, because if China is our focus, and that's our real problem, why aren't we solidifying our relationship with our allies? Why aren't we strengthening the North American platform with Canada and with Mexico, and then really saying to the Chinese, hey, you need to change, and we're going to ratchet your taxes or your tariffs up over a period, 25%, then going up, and give time deadlines so that there's actually an incentive to come to some kind of resolution. I think this chaotic approach is really disconcerting. I haven't talked to a senior business person here at this conference who isn't really struggling with how to manage through this. And so I've tried to ask myself, okay, what are they trying to accomplish, right? And I think ultimately they'd like more revenue, more money coming into the U.S. government. I think they'd like to onshore things like steel production or more aluminum production or more critical minerals or more lumber or more pharmaceuticals. Okay, that's noble, that's great. But I think there's a massive tax that's going to be put on the American people. And if you talk to people, they're feeling more and more insecure. So I think it's, I just don't get the strategy.
But I mean, they have a theory of the case, right? There is like some kind of intellectual framework around it. There have been that America has subsidized too much of the global economy, that we've traded too much of our sort of hard power for soft power, and that there's parts of the country that have been hurt by it and left behind. I mean, you've spent a lot of time in the workforce, like out in the country. Like, is there something about that resonates, that feels directionally true to you?
So what feels directionally where I think we should focus. How I would go about this, look, I'm a planful person, and you've probably heard me say before, I think we should have a competitiveness plan. And I'd go on offense, but what would I go on offense on? I'd go on offense in investing in infrastructure. I'd go on offense in investing in housing. We desperately need affordable housing. I'd have an immigration plan that actually works for everybody, that is understandable and people understand the rules, and create a system that works. We don't have that today. I would be much tougher on protecting our intellectual property, and I'd support our workers. And I don't think we've done enough of that. I think we have to, look, we're living in a changing society. Besides tariffs, you're also living with the age of AI. We're living with so much change. And I think that all of us are trying to learn. And I think so many people out there need support to be able to have the skills to be able to be effective in this economy in 2025, 26 and onwards. And so I think we need much clearer plans in that respect. And I don't get how this tariff experience is going to help those folks.
If the president woke up tomorrow and said, just kidding, it's April 1st, we're going to still be pretty tough on China, but everything else, which is kind of where they've landed, right, which is sort of actually we're going to strike some deals with our allies and then try to stand tough on China. Do you think the CEOs that you talk to, the folks that are here, can envision going back to April 1st in their head? Or what is the sort of lasting effect of this?
So let's talk about lasting effect and the importance of policy. When I think back policy takes a long time to have it be felt, right? And let's take semiconductors, right? 2015, the semiconductor industry comes into the Department of Commerce and says, we're going to be crushed. We've got a real problem. We created a task force. We developed a point of view with the industry. PCAST developed a report that led to actually recommendations that the Trump administration implemented that ultimately led to the creation of the CHIPS Act, which is now being adopted by Secretary Ludnick as the investment accelerator. That kind of consistent commitment to policy is really what is important. I think jumping from thing to thing is a real problem. It undermines our credibility, not just with our own people and with our own businesses, but across the world.
But this is a criticism of Democrats in particular, that they are a little bit obsessed with process. They come in and they have smart people and they create task force and they have ideas, and perhaps not as focused on the outcome. What did we get? And I realize that some of this is, there's a delay, and the Trump administration is perhaps coasting on that. They are better at branding accelerators, that's a thing people get. But what do you make of, there's a broader discussion now, I think, around the abundance agenda, but that the Democrats in particular should be less focused on process and more focused on outcomes?
Well, I think you have to do both. I think you have to have a transparent process that allows you to develop coherent and smart policy, and then you got to go execute, and you got to focus on whether you're getting the outcomes you desire, and you have to pivot if you're not. And so I think there's some truth in parts of this, but I think that it's not fair to say one's just all process or one's all outcome. Look at the outcome we're getting. Outcome with no process doesn't seem to be working either.
No, but I think that's the Trump administration. They do a lot. They get a lot of outcomes, and then they kind of try to walk back the ones they didn't like. And what people see is they're doing stuff, and I think that's sometimes
well, I think
galvanizing.
Seeing doing stuff, I get the desire to have our government do stuff, but there's also a do no harm aspect to this whole thing. And right now, I would say it's very uncertain, and that's problematic.
Yeah. You have a big role at Harvard, which has been in the news. What kind of reaction have you gotten to Harvard standing up?
Well, let me step back and first of all saying, being the senior fellow at Harvard, I'm very proud and honored to have that role. I didn't know what I was getting myself into when I started in that role. But Harvard was a very important place to me personally. I went to college there. I lost my parents very young, and it served a really important sort of time in my life of a place that meant a lot to me, and I made a lot of relationships that have helped me throughout my life. I'm proud of how the university has stood up to the circumstance that we've faced, which is really an unprecedented situation of government overreach. The demands placed on the university were just really so unprecedented and so beyond what anyone could have expected. And I think in general, the reaction has been quite positive. But I think in general across the country, people don't want our federal government running our universities and our colleges. You know, the research, the contributions to innovation, the important scholarship that's done at Harvard, these things, you know, those efforts, that work, that has a positive impact on our country. It has a positive impact on people's lives. It's important to the world. Now, don't also think that that the universities pushing back against government overreach doesn't mean there isn't a need for change on university campuses, and don't read it as a lack of commitment to change by Harvard. I mean, Harvard is very committed to addressing issues and combating anti-Semitism, to having a community that is strengthened by viewpoint diversity, that's free from hate and harassment. But on the other hand, what's at stake here is our ability to save American lives, to do the research that fosters, you know, that's part of fostering. We're not 100% of it for sure. We're a piece of it, of fostering American success. And we play an important role in America's position as a global leader. And so I have received, you know, enormous number of individual outreach, and the university has received extraordinarily broad positive feedback for taking a stance.
Harvard has a lot of very wealthy donors, has a very large endowment. Other universities are not as you know, well funded. Would you understand if sort of further down the ladder people felt like they had to strike a deal? Is this, are you kind of creating space for others to follow your coattails, or are you setting a standard that other universities just aren't going to be able to financially?
I think that if you were to talk to Alan Garber, who's the president, and talk to the leadership, they're trying to take a position, and the goal is to take a position that can benefit all of higher education. This is not about, oh, we can afford something and others can't. This is really about academic freedom. It's about First Amendment rights. It's about who do you hire, what do you teach, who do you admit into your schools, and yet always recognizing we have to follow the rules and follow the laws of the United States. And so it's trying to figure that out in a context where the federal government has basically delivered demands that are just unprecedented in terms of overreach.
You're saying it's interesting. It's about academic freedom, and it's also about anti-Semitism. And I'm curious, you're Jewish, I'm Jewish. Like, do you think that this is, we've seen anti-Semitism kind of be used as a cudgel, and I'm curious whether you think that's, what you make of that.
Well, combating anti-Semitism is very personal to me. The immigrant in our family came from what is today Ukraine and was Russia, and was driven out of Russia by pogroms, which is basically government anti-Semitism, if you will. And you know, I've fought anti-Semitism throughout my life. When I was Secretary of Commerce, I had the honor of giving a speech at the 75th memorial commemoration of Babin Yar, which if my family hadn't left in the late 1800s, they would have been killed by the Nazis at Babin Yar, where they rounded up 40,000 Jews in the greater, that part of Russia, and basically shot them, and then pushed their bodies into a ravine. So anti-Semitism is something that has existed for, you know, as we know, from time immemorial. I think that fighting anti-Semitism on campus is something we all have to do, and we have to make sure that our campuses are free of harassment as well. But attacking research, attacking who you're going to hire on campus, attacking life-saving medical therapies, I don't see how that's related to fighting anti-Semitism.
But maybe when we look back on this, that sort of Harvard standing up, and some law firms chose to settle, some chose to sue. Starting to see, I think, a little bit of stirring in pockets in Washington. A bunch of CEOs with the White House this week saying this is not great. Like, I don't know. Do you see a bit of a pushback forming? Is there a way to? I don't know. What do you make of? Is there a path
I think
to pushing
there
back
are
here?
220, as last count, presidents of colleges and universities just signed a petition, and that number seems to be growing every day. So I don't know what the number is today of presidents of universities who are signed a petition that basically says that, in support of academic freedom and First Amendment rights. I think that we're, yes, I see the momentum building. You just saw the Big Ten colleges and universities are coming together or are being, I think their faculties would like them to come together to fight the overreach of the federal government. So I think there's movement that is beginning and starting. I particularly appreciated when Steve Kerr wore a Harvard basketball T-shirt when he was giving his NBA interview. So I think that people are developing greater consensus and maybe more courage.
Well, thank you so much for joining us.
Thank you, Liz. Great to be here.
Thank you. I appreciate you. Take me right on.
Thank you.
Please welcome Alex Chris, CEO of PayPal, and Gina Chan, Senior Editor at Semaphore.
So, Alex, you have a great purview over what's happening in the economy, both here in the U.S. and globally, given PayPal's reach, and you also, your company also owns Venmo. What are you seeing in terms of the economic effects of the uncertainties just on sort of everyday people, small businesses, and other users of your platform?
Yeah, well, thanks for having me here. It's great to be here. And yes, PayPal serves over 400 million consumers and close to 40 million small businesses around the world. We do a quarter of the world's e-commerce runs through PayPal. And so far, we've seen a pretty resilient consumer. We haven't seen a lot of changes globally. I was in Europe a couple weeks ago, and what we're seeing from merchants and consumers is, with uncertainty and tariffs, they're starting to just buy domestically instead of internationally, but so far it's been a healthy consumer. I think the thing that I worry the most about is small businesses. Small businesses are the lifeblood of our economy, from both employment as well as revenue. And the reality is many of them are getting goods from overseas and putting their special brand on it, putting their special packaging on it, and then selling it locally. And I think they're working on incredibly thin margins and cash flows that oftentimes are 30 to 45 days at best. And so disruption there and uncertainty can really put a strain on the small business economy. And I think that's something we've got to watch.
Yeah, and from past experiences, we've had, the financial crisis, we've obviously had the pandemic. How much time are you giving in terms of seeing patterns of where small businesses, where consumers are going, given how fast things are changing?
Again, it all comes down to cash flow, right? Small businesses survive on money in, money out, and access to capital. Money in is, how often are people going to actually pay them? And for service-based businesses or product-based businesses, that money goes, if there's any delay in their ability to have money in, the challenge is their money out, their payroll, their bills, that stuff stays consistent. And so that cash flow of, maybe 30, maybe up to 90 days gets squeezed very, very quickly. So then it goes to access to capital. And the challenge is small businesses are the ones that have the least access to capital of anyone. It's one of the things I'm very proud of at PayPal. We've put $30 billion of working capital loans into the small business community. It's our ability to see differentiated data and ensure that we can support our small business merchants, but we can't do it alone. And it's just something that I think we need to watch, because they don't have 6, 9, 12, 18 months of cash flow to be able to survive.
Yeah. Well, and this is, given all the economic uncertainty, this is one conference where AI has not been the topic du jour, but obviously every company is trying to figure out how to take advantage of this technology, including PayPal. How are you deploying it in terms of helping consumers and small businesses, and particularly for small businesses, in terms of improving productivity, taking more advantage of the data they have? How are you helping them take advantage of this?
Yeah, I see AI as obviously tremendous future advancement. It is here, but it's also one of those things that, if I first focus on small businesses, they are the underdog. The playing field is not level. And if you think about what you need to take advantage of AI, you need tremendous amounts of data, and you need tremendous amounts of really good data scientists. Those are two things small businesses don't have. By definition, they are just cash-strapped, human resource-strapped, and they don't have access to data. And so we look at platforms like PayPal and say, hey, we have to be that platform that we do have tons of really, really good data scientists and tremendous amounts of data. So how do we leverage AI to give our small businesses that competitive advantage? How do we let them understand what products they should be bringing in, who they should be selling to, where else they should be going after consumers? And so we're leveraging our AI platform to be able to empower small businesses. If I also look at consumers, though, I do think we are moving into a really exciting but unknown future of shopping as well. I think we're heading towards agentic commerce. I think if whether you all are using different AI agents, I know that my kids spend a lot of time talking to AI agents. They're sitting there on their phones having conversations. And part of those conversations inevitably lead to some sort of shopping potential. And so I don't think we're very far away from being able to go from a normal shopping cart on a shopping page to, hey, I want to go on a trip and I need a new outfit and I need, to arrange travel and transportation. And having an agent actually do that on your behalf is both really exciting, but also creates all sorts of uncertainty and challenges. And I think that's an opportunity for us to be able to protect consumers the way that we always have with PayPal, but make sure that safety, security, your data privacy, and all of that is well protected while we're moving into this future of commerce.
Yeah, and in terms of the risks and sort of safeguards, because it's great if your AI agent that does tasks on behalf of you can plan your whole trip, your hotel room, your airport pickup, whatever. But obviously, data is what makes AI really attractive, but also scary. So, it's especially for consumers and on the fraud front, what are you doing to ensure that if it's actually me buying these things and not someone who's subsumed my identity?
Yeah, I mean, we're already seeing bot attacks, fraud attacks skyrocketing right now, and with agentic commerce, it's only going to go through the roof.
And how are these attacks being initiated? Like, are they because with AI you can also fake people's voices, the sort of way to the phishing attacks and everything, it can become really sophisticated.
Yeah, there's some of that. It's even simpler, though. It really is. I mean, there's just, we all know there are people out there that will take credit cards and just try them a million times, or try to get through some sort of checkout process. And being able to leverage AI to just test the risk and fraud capabilities of different merchants, it's just easier and easier. And so this is the constant battle of AI between fraudsters and between folks like us that are trying to protect consumers and protect merchants. But again, if you then think about the next version of that, I do think we're going to get to a point where you're going to want, I mean, just think about the efficiency of an agent-to-agent commerce transaction, right? Just think how much simpler it would be to allow a trip to be able to be planned where agents can understand your data, make it all work for you, negotiate on your behalf, get you the best price, and actually complete it. That's wonderful, but you really want to make sure that you don't want to wake up and have your money gone from your bank account. And so we are working very hard across our consumer network to ensure that biometrics are in place, that agents understand when they need to actually ping the consumer, what are the rules that consumers have put around their wallet. And we have a smart wallet through both PayPal and Venmo that allow consumers to actually put rules and understanding so that agents are working on your behalf, not surprising you with new purchases that you didn't know about.
And for small businesses, what are you seeing in terms of their needs? Because for big enterprises, the Walmarts of the world, they can take any AI model and customize it to the hilt and personalize, train it on their own proprietary data and do other things that really use it to its fullest advantage. But there are lots of costs, as you said earlier, to that. How much can they really take advantage of it given some of those limitations?
Yeah, the good news for small businesses is that their needs are actually very simple. They just want customers. They need more eyeballs. They want more customers to show up. And the question is, how do we enable AI? How do we enable new ways of searching to make sure that their products and services, which oftentimes are very well priced and bespoke and beautiful and things that consumers are searching for, but I mean, if you think about today, if you go into a normal search engine and you type in, a couple of keywords for a product, it is unlikely that a small business is getting on the first 2, 3, 5 pages of those search results. They just can't afford to be able to pay for those paid results. So AI could actually turn that around, right? If you're putting into your personal shopping background that you want those bespoke purchases, you want something that's local, you want something that is made locally, AI can start to take those preferences and actually give you the right answer. So we think that's a really interesting opportunity that we're, again, leveraging our data and leveraging that two-sided ecosystem that we have with PayPal of, again, the hundreds of millions of consumers and tens of millions of merchants to be able to make those connections.
And I wanted to talk to you a bit about the regulatory environment, because that was one area that many business leaders were hopeful about when it came to the Trump presidency. And sorry for the feedback here for those in the room. But some of the areas in terms of antitrust or other areas have not really worked out in the way that the business community had hoped for, where antitrust actually seems to be tougher or as tough as the previous administration. When it comes to the Consumer Financial Protection Bureau, which had been pretty aggressive on the Biden front, we're waiting to see what happens with that agency, but it is clearly not going to be as strong as it was before. How is PayPal navigating the regulatory environment, which is also uncertain on top of everything else going on?
Well, everything seems to be uncertain. Let's talk about where we are seeing good progress. We're very involved with what feels like really good progress on the stablecoin bill. And we just actually yesterday launched, we have a stablecoin, it's called PYUSD. It's one of the first regulated stablecoins. We've actually had it for the last couple of years. Just yesterday, we announced that we're actually giving consumers and businesses back the interest in terms of rewards that they're able to manage on holding their stablecoin. So 3.7% back to consumers and merchants. That's been very, very well received. Today, we actually announced another partnership with Coinbase to be able to enable our stablecoin to be able to move. And why is that important? There's a lot of fees that happen in every purchase. And if you're a business and you're working on incredibly thin margins, if $3 out of every $100 that you make goes to somebody through fees, or if you're doing cross-border transactions and it's $4, $5, $6 out of every 100, those are just margins that are eroding very, very quickly. If we can leverage new financial systems, new financial rails to be able to put more money back into your pocket to ensure that you're able to get paid safely, securely, and incredibly quickly, we think that's a huge win for the economy and for our businesses. So we're leaning into that. That seems to be making progress on the regulatory front, and our voice is very strong there. And so we're excited about that future.
Yeah. And really quickly before we go, will PayPal ever become a bank?
It's not a plan. I think what we really like is people conducting commerce. We like having merchants be able to sell, having consumers be able to spend. We're doing that, whether it's peer-to-peer, whether it's buying online, whether it's omni-channel and buying in store. That's the future for PayPal and for Venmo. And we're doing that across the world. So banks have
don't have to deal with all the capital rules of banks.
Banks have, we've kept it very balance sheet light, and we'll let banks do what banks do really well, and we'll help our consumers and our merchants transact commerce around the world.
Great. Well, thank you so much, Alex.
Absolutely.
Please welcome Nandan Nilekani, co-founder and chairman of Infosys, and Gina Chan, senior editor at Semaphore.
So Nandan and I have our annual reunion at the World Economy Summit. So I'm so glad to see you again.
Great to be back here.
Yeah. So Nandan, before we dive into AI and all the exciting things happening on that front in India, I just wanted to get your pulse check of everything going on in the world in these uncertain times, which just seems to be the buzzword lately. Is that having any sort of effect in terms of AI deployment on the infrastructure build out, where people, data centers still need various components and parts that are getting caught up in some of these trade tensions? How are you seeing the landscape?
No, I think more than the macro issues, I think the real question is how do enterprises deploy AI? Because AI, there's a general principle in enterprises that the more complicated or the more intrusive a technology is, the more difficult to implement inside a company. Because companies have lots of complexity, they have systems built over the years, they have data in silos, a lot of issues there. And we saw that with the cloud, because the cloud actually, the first time you actually put in a technology where you have to replace something, and now 17, 18 years after the cloud was introduced, we're still at about 25-30% penetration. So I think AI is even more complex because of data. AI is only useful if it works on the data of an enterprise. And that is very hard to organize for AI. So I think that's going to be your gating factor rather than a macroeconomic issues.
So for companies that are trying to deploy it at scale, because they seem to have moved past sort of the experimentation phase, they're kind of gotten over the hype phase, but as you say, deploying it at scale, company-wide, and getting employee buy-in and organizing their data and figuring out even what data they have. A lot of companies are finding like it's so siloed, they actually don't know all the useful information they carry. What are the biggest challenges, and what are the biggest sort of unblockers of getting over those?
Well, I think as you rightly said, I think the last year was a lot of it was people doing pilots, experimentation. At Infosys, probably 400 customers are doing some AI work or the other. But a couple of things. One is after the experimentation, people are realizing that they need to have an architecture, a strategy, how to organize all this at scale, how to organize the data at scale, how to create multiple models, how to there's a people issue, and then there's a business workflow issue, because how do you bring this into the workflow of the business is the hard part. But I think the big thing which is happening now is applying agents which are genuinely useful to businesses, because if you can have an agent in your business process, order to cash or procure to pay, or whichever are the business process, and you bring in agents, there's a significant productivity benefit. So I think enterprise will be driven by agentic capabilities.
So we just heard the PayPal CEO talk about the costs of taking on this technology, and people needing data scientists and other kinds of experts. What are you finding in terms of businesses realizing or not realizing whether this technology is worth the premium that's put on it?
No, I think that's why I think the agentic thing, more than just the chatbots, the agentic stuff is showing companies real value. They're able to implement it, they're able to reduce costs, improve customer satisfaction, reduce time to market, reduce time to collect money, real hard business issues. So we're seeing that. I think that will be the tipping point on usage. So that's why I think the takeoff will happen. But you can't again implement it in silos because over time you'll create a new set of legacy applications. You have to think through how do you put all of it together on an enterprise-wide architecture, and that's where the best companies are trying to figure that out.
Yeah, and what about deploying the technology for societal effects? Because there's kind of a sense of like this is going to become like a have and have-nots of companies that can afford it, consumers that can afford it are the ones that will benefit, and the society writ large is sort of not taking part. But you've talked, and when we were here last year talking about how AI can help India address the teacher shortage.
Yes.
By having AI be the tutors and the educators. Where are you seeing the places where it can have the most benefit for society?
No, that's a great question. And on my other hat, I am involved in India's national digital infrastructure. So obviously, AI is a big part of that. So 2-3 cases. One is using AI for language. India is a country with hundreds of languages and dialects and 22 official languages. And now using AI, there's automatic voice translation of these languages being rolled out with Indian data. You can't just train this on the web. You have to go and get samples of people talking in a village or something. So language is a big use case that's being rolled out, and the government has a program called Bhashini, which does something like 300 million inferences a month. So it's already at scale, applying AI to a social issue. The second example is education, and now many schools and states are now rolling out using AI-based capabilities in a safe environment for children to improve their because many kids don't even know how to read well or write well or to compute well. So it's not about having a smartphone app. It's about getting children to learn
the basics.
Yeah, it's very basic. And these are the children who are struggling around the world. So there's stuff happening now on that. And the third big one is on agriculture, because again, India has a large number of farmers. You have to improve their productivity and so on. So a lot of work on applying. So I think people are taking these very strong social issues and building AI at scale to make it work.
Yeah, and what are people finding in terms of their experiences with that? Like you were saying, for education, for kids, for basics, if they're already disadvantaged where they're not getting the education they need, then what kind of technology do they need to even access?
Yeah, so think of them as practice AI, in the sense, what happens to a child if he or she is in a class where she's significantly behind the other kids? He or she is too embarrassed to even speak up, and ultimately they drop out. But if you can create in the safety of some kind of a lab where they have their own speakers and they are talking to this AI, and the AI is very gently correcting them, and the AI figures out that they don't know this syllable or they don't know this vowel or whatever, then by practice, the AI helps them get better. So this is a safe space. The teachers like it because they don't, that gets happened and then the kids can come back. So you have to think through all this. How do you make a safe space? How do you make it non-embarrassing for the kids? How do you create a model where if the child is willing to invest time, they can get better? And we are seeing some good results now. We're going to get researchers and impact and analysts to actually see the benefits. But I think the first indications are positive.
Yeah. And what about the safeguards and AI safety? The Alex from PayPal was talking about, with AI, bad actors can, take advantage of the technology too. What are you seeing, from a regulatory framework perspective?
Well, I think the regulation AI is quite diverse. Some countries don't have any regulation at all. Some regions have very restrictive regulations. So it's not a uniform thing. And that's one is, of course, to prevent those things happening. But if you're a company developing, which is a global multinational, when you build an AI and roll it out, you have to make it conform to different regulations. And you have to do it a priori. You can't build it and then say, oh, let me make it work here, make it work there. So I think building for the world requires you to be very cognizant of the variations in regulations. In fact, at Infosys, we have put out something called the Responsible AI Toolkit. It's a completely open source learnings of how to build AI responsibly, because we think that should be a public good.
Yeah. And I wanted to ask you about India's place in the AI race. Like a lot of the conversation usually revolves around the US and China, and we've seen the reaction around the DeepSeek model that China had deployed and how much that hit NVIDIA's stock and various others. But India is a player too, and including in sort of the war for talent.
Yeah.
Where do you see the country's place, and what more does it need to do to keep up? Because we were just hearing from some other tech leaders that the U.S. is ahead right now, but actually not by as much as maybe many people think.
Well, I think, first of all, India will definitely be a huge talent pool for AI. Already, if you look at platforms like GitHub, India has the second largest set of developers on the platform globally after the US.
Yeah, I remember last year you were like, there's no more Chinese on GitHub, there's only Indians.
Same thing with students, but I don't know what will happen there. But so that's on the AI talent. But the other area where I think India will lead is actually deploying applications that make sense for people. We talked about that. Because the way it works is, it's not about AI replacing jobs, it's about AI amplifying human potential. And in a society where there are not enough doctors, not enough teachers, can you actually use the AIs to improve the productivity substantially of teachers or doctors so that more people are reached with services? So you're going to see that kind of a trend. So I think India will be the use case capital of AI. And there will, of course, be, people will build their models and all that. But increasingly, the competitive thing is going to go into applications. How to use all this stuff. It's nice to build more models, but you have to make it work for some useful purpose. In that area, India will lead.
Yeah. Well, it's interesting you bring that up because, what we now know as ChatGPT, the experiments of, working out some of the kinks, the, quote, hallucinations was done in India first.
Yeah, sure. So I think that's the other point, that if you're going to build for businesses and governments, you're putting a brand at risk, right? I mean, if you're using some consumer chatbot and it gives the wrong answer, it's not a big deal. But if a company's products give wrong answers, then it's a blowback on the brand. So I think, therefore, that deployment will be much more measured and careful. And that's what we're seeing around the world, that people want to absolutely make sure that they're trained well, the data is curated, doesn't hallucinate, there's no bias, there's no embarrassment. Only then they want to roll it out.
Yeah. And you talked about energy being the next UPI revolution, and UPI is famously the digital payments system that really unlocked a lot of growth in India. How do you see that in the context of AI, given the energy demands of the technology and the infrastructure needed to really deploy it? I mean, already, there's various limitations on build-outs, even here in the U.S. because our energy infrastructure isn't as robust and sort of vast as we want it to be.
Sure. Well, there are multiple facets to this. One is AI as a consumer of energy will be a big consumer because of the AI data centers, and we have to plan for that, which is why many of the companies are looking at nuclear and so on. So that's one part of it. The other is using AI to make the grid more efficient, using the AI to do demand supply forecasting of energy, fault detection, consumer experience, and so on. But the larger issue is that the electricity grid, the grid part of it has been pretty much static for 140 years since Edison and Tesla. Remember, they had a thing called the current wars, where Edison was proposing DC current and Tesla and Westinghouse were proposing AC. And that got settled in 1890. After that, the thing hasn't changed. Suddenly, the grid is facing all these challenges. One is on one side, the renewables coming with intermittent power and using batteries or pumped hydro. But more importantly, every home will have energy production with the solar unit. It will have a battery from its EV car. So when millions of people are producers, consumers, buyers, sellers, and storers of energy, the grid has to completely be transformed. So that is the real challenge that's there. And if you transform that and then build on top of that AI with all the data flows, then it will be pretty awesome. But this is a multi-year, multi-billion-dollar journey.
Yeah. Well, hopefully next year we'll see
Sure.
where the progress is.
Thank you so much for having me.
Thank you so much, Nandan.
Thank you, Gina. Take care.
Please welcome Aparna Bharadwaj, Global Leader of the Global Advantage Practice at BCG, and Gina Chua, Executive Editor at Semaphore.
So, the special sauce of this panel is that we have two Singaporeans.
Yes, we do, yeah.
So
when does that happen? Here in
Never
the US?
happens. We did it specially just for this. So your practice is global, but you are in fact based in my home country. And so I thought we'd try to get an outside-in view of the US and what's happening certainly on the tariff front and policy front. So let's talk about Southeast Asia. Let's talk about ASEAN. Big trading group, mid-income countries. What are you advising those companies who are sort of in the middle of all of this? They're not China, they're not India, they're not one of the big players. They're sort of adrift in the waves, if you like.
Right, right. No, so that outside-in view doesn't get discussed often enough, but the reality is that any country that responds to the US tariffs at this time has two constituents, right? One, you have to respond to the US, and you have to do that negotiation, but you also have to keep an eye on your own public, your own citizens, and how they are going to respond to how you react. You cannot come across as weak, but you also cannot come across as allowing business to suffer. And so I think that's the tussle that's happening. The way ASEAN has done it, and the Special Economic Ministers meeting said, we don't want to retaliate. We want to find a proactive way for a solution. And we want this to be a multi-pronged conversation that is not only about trade, but about multiple levels of relationships with the United States. But at the same time, they're also finding a middle ground between China and the US. I mean, Xi Jinping was on a rare tour of ASEAN. He spent 3 days in Vietnam, 3 days in Malaysia, sometime in Cambodia. He got 40 over trade deals in each market, and it's a tough one. So then, as soon as he left, the Prime Minister of Vietnam said, I have a special relationship with the United States. And you got to navigate that very carefully. So I think for these countries, there is that challenge. And for the superpowers, it's easier. For China, for Europe, for Japan, you always have retaliation in your back pocket. Right. You say, we're going to try and make a deal, but we don't want to appear weak. We will retaliate if it doesn't look like it's going anywhere. But for the emerging markets all over the world, they have to find a solution that allows the economy to grow. Because businesses, governments derive their legitimacy from the GDP growth. And that's a difference. Yeah.
So that's at the governmental level. What do companies do? What does a mid-sized Philippine, Indonesian, Malaysian company do, just given the dynamics that you've laid out?
Right now, they're just waiting and watching, but they're also trying to be a bit more agile. So unlike entrenched large businesses where you've got these supplier agreements that are 3-4 years long, some of these mid-sized businesses are trying to find a path by which they can move suppliers a bit more quickly. Some of them are doubling down on opportunity, right? So businesses in India are looking at opportunities they can get from manufacturing for the US market. Right. And they're trying to lobby their governments, right? So that is, if you see, there's a lot of conglomerates in these markets, and those conglomerates wield a lot of influence with the governments. So they're trying to create pro-business outcomes on the back of that.
Are they able to, are you seeing businesses moving quickly, or are they trying to find opportunities, or are they somewhat paralyzed? Are they watching and waiting? And how long can they afford to wait?
It is very similar to what I heard this morning about businesses in the US. There is a pause button that everyone's hit, right, saying, I actually don't know what to plan for. Right. Planning for a 10% tariff during the pause versus planning for a 25% is very different. Right. If you're a food manufacturer, that's your entire margin times 3, right? If you're a garment manufacturer, that's your margin times 2. So there's a big difference on how viable I'll be in each scenario and which markets I would go to. So yes, paralysis is a big theme. Uncertainty is a big theme as well. And then trying to figure out ways by which they can just stock up inventory and wait this out. Now, they can do that for 6 months. But if this goes on for another 6 months, right, I think that's where you have to start making some decisions. And I worry about that more.
So the Southeast Asian countries, as you say, really don't have anything in their arsenal, and they are being squeezed on both sides. Take a country like India. What does its response look like, and what do those companies do? Yeah.
So I think that is where we need a lot more thinking of that poker game. I heard the poker game reference this morning a few times. What are the cards that India has, and how can India play this, right? It's a multi-pronged deal. You can buy more defense equipment from the US, right? You can reduce tariffs on Harleys. I think that's an easy one, right? Go ahead and do it. Indians will be happy about that. But then it comes to 2 things that can be trickier. One is allowing US agricultural imports into the country with lower tariffs. Now, in India, a huge chunk of the population is in farming. It is not extremely industrialized compared to the US and China. And so are you going to open up the farming sector and expose those farmers to global competition? That's a tough one. And that is connected to the voting bloc.
Exactly.
And how farmers vote. It's a big voting lobby for Prime Minister Modi. So that's where it gets harder. So there's a few things you can do relatively easier, and then there's a few things that get a bit harder for us. When you go to China, I mean, honestly, I'm surprised that anyone is surprised that China retaliated. Like, they had to retaliate. It's the 2nd largest economy in the world. They consider themselves a superpower. They cannot appear weak. And if you remember, in the post-COVID period, China had this phase of what they called wolf warrior diplomacy, right? Where Chinese diplomats were speaking tough words in the global scene. How can you be seen as weak in a negotiation with the United States? So they had to retaliate. So for some countries, the position is clearer. For some countries, there are things you can do pretty easily, and then things that are harder to do. Back to ASEAN, you can easily reduce tariffs. You can allow US investments into your country. You can do all of those things. But if you have to decouple with China, that's a harder one. Vietnam, Thailand, and these countries need time and capability building to fully decouple from China imports. So those become harder parts of this negotiation. So you've got to see it from 2 sides.
So what does a non-agricultural Indian company do if they are sort of sitting and looking and thinking about what the government might be able to trade off?
Yeah. One thing I know about Indian businesses is that they're very entrepreneurial and very agile, right? So Indian manufacturers are looking to find opportunities here that allow the cost position to be viable overseas. Even at a 25% tariff, there's a path for Indian companies to be cost viable versus global players. They're also seeking to bring investments in to say through a partnership. I mean, it was quite interesting that Shein is entering India after a big gap with the Ambanis. And that was quite interesting as well. So India's playing this very pragmatically, I'd say, trying to get closer to how Chinese businesses work with Indian businesses, while at the same time working with the United States to find solutions. And Indian businesses, I would think, are very agile in trying to navigate.
And obviously, apart from just looking at diversifying your supply chain, you're also looking at diversifying your markets. If you're heavily dependent on the US, maybe that's not such a good thing in the long run.
Yes. I think in that, despite the uncertainty, and this is something we say to our clients all the time, is there are some no-regret moves despite the fact that you don't know where the dust is going to settle. First, don't change over-dependence on one country and replace it with over-dependence on another country. Have diverse supply chains and have a spread in where you source from. That's a no-regrets move. 2, you need more buffers in your supply chain. So just in time, assuming supply chains will work seamlessly, it's not going to work. So yes, I think we talked a bit about pudgy companies this morning. It was fun. It was a good description to say you need to start buffering your supply chains and having inventories across the board. And third, and this is interesting, in India in the 70s, you know, when I grew up, we used to say this term called license Raj.
Yes.
License Raj has now come to the world, right? And so we have to find a way by which companies don't have trade compliance experts. They don't have people who can understand regulation. They don't know people who can work this regulation to minimize the burden on trade execution, not lobbying, not outcomes, but execution. And I think all those people will have to be found very quickly and hired very quickly. And so
it's a growing field. So let me just switch over to that for a second. You're a product of Harvard University. I'm a product of Columbia University. Both of us have gone through the American higher education system, and which has essentially produced a huge amount of talent around the world. And obviously, both our alma maters are in the news today, shall we say. What happens if this continues and in a sense the US loses some of this intellectual capability? And what happens to the talent flow, and where do we go from this?
Yeah, it's interesting. I mean, part of this is personal, but let me try to address, because I'm from Harvard Business School. I'm a global citizen. I took that graduate degree, and then I traveled the world, and I'm in a global role, right? So part of this is personal. But let me zoom out and think of the talent question that you asked. I think at the end of the day, there are very few countries in the world who can have their choice of the best talent from the world, right? Singapore tries to do that very deliberately, right? To say, across Asia, let me try to find the best talent, attract them into Singapore, and have a path to citizenship for a subset of them. US does that times 100, and has done that organically for several decades. And it's a good position to be there, because then that talent comes and innovates, that talent comes and drives all of those things. So I think not just for the US, but even for Europe, for Asia, you'll have to think about it in terms of what I call the talent triangle, right? On one hand, you have global migration, and you need to be open to the best talent of the world in order to create innovation, in order to have some of the best AI talent, some of the best tech innovators into your country. The second tip is skilling your own people. How do you move your own people up the curve? If you have limited ability to bring talent from outside, you got to skill your own people. And the third, frankly, is AI and technology. Say US wants to create manufacturing jobs in the US, there are not enough Americans wanting those jobs, then you got to find AI and technology. Every country is going to have to balance that talent triangle. You can't block all three. You can't say, I don't want AI, I don't want migration, and I can't do skilling. And you can't do all three either. So I think those choices are going to get a different reframe. US was able to have good migration, move up on technology, but with limits, and of course, do some skilling, but get away with not that much of it, right? So now you got to do all of it. And that's the question you have to figure out.
And I think we've run out of time. So, but I would love to carry on this conversation, but thank you so much.
Thank you for having me. Thank you.
Please welcome Kevin Rudd, Australian Ambassador to the United States, and Amna Nawaz, co-anchor of the PBS NewsHour.
Hello, everyone. Yeah, we'll take that. Ambassador Rudd, that's for you. So pleased to be here in conversation with you. Thank you so much for being here.
I'm very glad to be here in my private scholarly capacity, not as an ambassador. That's my excuse, and I'm sticking to it.
He thinks that's going to get him out of some of these questions, but it won't. I do want to note, I read in your bio, and I found it to be a great interest. You, early in your diplomatic career, began your career in Beijing and served there on the ground. I just want to begin kind of with your view of China right now, the Chinese economy, how they are navigating this moment of this trade war with the United States, despite the talks of de-escalation, and we don't know what's going to happen next. But under this growing pressure of the Trump administration, How are you viewing how China is looking at this and what they might do next?
Well, every country, including China, begins with its domestic politics and its domestic economics. And the beginning of wisdom is to understand how reality is seen through the Beijing lens. I think the first thing to say is that China had a slowing growth problem over quite a number of years. In fact, the economy even prior to COVID in 2020 was slowing, and certainly since COVID failed to recover its historical growth rate. And that's been a matter of huge internal policy debate within the Chinese system, culminating in some changes in the last several months to re-embrace the private sector. And we've seen that in a number of policy pronouncements. Then on top of that, you add, let's call it the US trade agenda. And of course, if you look at the structure of the Chinese economy, like any other economy, it either is driven by domestic consumption, where frankly in China, its domestic consumer confidence has been low. Private fixed capital investment, private entrepreneurs have been anxious and not investing, at least until recently. So what are you left with? You're left with private residential construction. Property market's been in trouble. So you're then down to public investment and net exports. And so there's no magic to this. So net exports being a large contributor to China's overall economic growth rate now, in the face of 145% tariffs, is therefore a very large threat to China's sustained growth levels. So we are in a very serious debate. As I said, on the economy, growth was slowing already for a range of domestic factors. And now we have this external factor, which is large scale.
What are the ways in which that pressure could be alleviated for China? I mean, I read one Chinese businessman say something like, when the West is dark, the East is bright. And we saw President Xi visit a number of other Asian nations, right, trying to make the case for trade there. Can China turn elsewhere? Can it make up for the loss of US trade with Vietnam and Cambodia and Malaysia?
And not if you look at the global economic pie. America is huge. That's just an empirical reality. If you're 22% of global GDP, you might only be 15% of global trade, but this is a very large slice of global economic activity. And the American consumer, as we know, has been the backbone of so much of global growth in recent decades. So China's strategy, if you were to look to the future, I think goes into a number of different possible approaches. The biggest one for them still lies in domestic policy adjustment. China, as Secretary Bessent was pointing out in an address yesterday, has not yet fully embraced domestic consumption as the principal future driver of growth. Theoretically, it got to that position in a policy document of about 2013, but frankly, it was never fully implemented. And if you look now, the savings rate in China is up, the public investment ratio is up, but the private consumption data, frankly, is not where it should be. So if you're trying to generate the next increment of Chinese economic growth, it must come from domestic consumption. And so whatever China now does in terms of trade with third countries, whether it's the Europeans, the rest of Asia, Latin America, Africa, that's a secondary set of possibilities, but the big numbers would come from China's domestic economic confidence, domestic consumer growth, and to cause the Chinese consumer to stop saving, and for that to occur, Chinese consumer also needs to have confidence in the domestic settings of the country itself.
What about Australia's view in this? I mean, there were reports about Australia turning down China's offer to so-called join hands, really, against the Trump tariffs. Does that give us insight into how you see your trade relationship? You're prioritizing getting to a deal with the US over deals with China, which I understand is still your largest trading partner.
Well, we in Australia for several decades now have mastered the eternal principle of Australian international relations theory, and that's called walking and chewing gum at the same time. It's not terribly sophisticated, but we think you can walk and chew gum at the same time. And we are chewing gum with America, we're walking with China, or we are doing the reverse, but we understand that both these economies are extraordinarily significant. Obviously, China is a significant trading partner of Australia. We also in Australia are one of America's single largest bilateral trade surpluses. But then there's the investment relationship as well, where frankly, American inbound investment into Australia is still the largest source of external investment in the world. So these economic relationships are complex, but anyone who seeks to turn this into a binary, I think will have great difficulty given how intermeshed the economies of not just Australia and the United States and China, but the rest of the Indo-Pacific. Our friends in Korea, our friends in Japan, our friends in Southeast Asia, these are all deeply intermeshed.
I know it's difficult and delicate to talk about this while there are ongoing negotiations between Australia and the US on the tariffs on your nation.
Sounds like a bad question coming.
But look, tariffs are one of the single most impactful forces on the world economy right now. So I have to ask, what can you tell us about those conversations right now, about the tone and tenor of the conversations, about if you're clear what it is the Trump administration wants from Australia or not?
Well, leaving our bilaterals to one side, because we're one part of this broader equation, and I'll come back to our bilaterals in a minute. The bottom line is that I think what's clear on the central question here, which is, can you begin to find a framework to stabilise the US-China trade and economic relationship? That's the central question for all of us. I think many of us have been encouraged by recent statements by the Secretary of the Treasury, also by President Trump himself, about the need to find, my words not theirs, an off-ramp to where we've been in recent weeks and months. What we do not know yet is what precise form and shape that will take, but I know that the administration will be keen, as I'm sure those in the Chinese administration will be keen to find a way through on this. And that is so fundamental to the future stability of markets. You know the downstream consequences of any further bifurcation of the two economies. The supply chain impact will be enormous. The inflationary impact will be enormous. The disruption to the global economy will be enormous. So it is in our collective interests for this particular negotiation to get underway.
If I may, Secretary Bessent also said a trade deal with China could take years. Certainly you don't want negotiations with Australia to take years, right?
No, we're not that patient. I think, but no, we are deeply engaged with our friends and partners in the administration, all the relevant cabinet secretaries. We've been that way engaged for some months now. And so we have optimism that we'll be able to land an arrangement in time. But the US is currently juggling multiple negotiations with many countries at the moment. And Australia is in the middle of its own general election. That election will be held on Saturday week. And I'm sure we will see the administration continue to engage. I've had no problem with access to the administration. I speak to the relevant cabinet secretaries on a regular basis. But these things take time.
When you say in time, is this a matter of weeks, months? Do you know at this point?
I don't have a crystal ball, and what I've discovered is the crystal balls, when you drop them, shatter into 1,000 pieces. So I don't know. But what I'm saying is that the pattern of our engagement with the relevant cabinet secretaries is strong and it's consistent. But I think all of our focus here at this particular conference goes back to the central question of US-China and can we stabilize?
It's, in terms of the relationship between the US and Australia, I mean, economic ties are obviously a big part of it, but there were also recent polls I read with interest about something like 92% of Australians who watch politics in the US and would say that political instability in the US is very important to them or is a critical threat to Australia's own vital interests. I mean, given the link between these two nations, given where they are, I'm just curious from your perspective, how do you, as the man tasked with building and maintaining this bridge, how do you navigate this moment?
Well, Australia is an all-weather ally and strategic partner of the United States. It's been that way for 3/4 of a century. The origins of that lie in the dark histories of the Second World War. And so these things are deeply entrenched. Our formal security alliance, of 1951, the Five Eyes intelligence arrangement, our AUKUS arrangement, our Quad partners with both Japan and with India, our free trade agreement. The institutional framework of this relationship is in solid state. So therefore, when I look, for example, at continuing Australian opinion poll data research, which indicates a continuing high level of Australian support for the security alliance with the United States, that's the fundamental factor. Having been a Prime Minister of the country myself in the past, it's my melancholy duty to report that politicians come and go, okay? But alliances relationships, when they're based on common values and common interests, are enduring. And so, therefore, I think we need to take collective deep breath about these things. And I'm sure that's the position of both the major political parties engaged in the Australian election at present.
Only because you mentioned the Five Eyes, I have to ask, Australia and US have like a 75-year intelligence sharing relationship there. Any of the headlines about the unsecure signal chats between administration officials, have they made you question that relationship or trust the US any less?
No.
If we had more time, I would follow up. Ambassador Kevin Rudd of Australia, thank you so much for being here.
Good to be with you.
Please join me in thanking him.
Please welcome Henry Wang, founder and president of the Center for China and Globalization, and Morgan Chalfant, deputy Washington editor at Semaphore.
Henry, thanks so much for being here. I want to start off with the topic everyone is talking about, which is the US-China trade war. And I'm wondering if you think that the US and China will eventually cut a deal.
Well, I think that things are starting to relax a bit. I think I saw what U.S. government officials have been saying. Things lately is a little relaxed, and I think also China has they had appointed a chief trade negotiator just recently also. So I hope that there will be more exchanges and initiatives, and then we can start to see things probably get better. But of course. Since U.S. has initiated this trade war, I think China is probably expecting U.S. To really put a plan and agenda as how to tackle this issue, rather than just saying, here and there is a fentanyl or trade numbers and all those different things, because we have to really have a genuine, sincere discussion rather than just talking through the micro speakers.
Mm-hmm. And if there isn't a deal, I mean, are there other tools that China can look to exact further pain on the U.S.?
Well, I think China actually is quite prepared already, because since the first term of Trump, we remember China already experienced a trade war and actually lived on that for a number of years until now. And you can see the trade number jumped from first term to now, has gone up almost 20%, where China's dependency on the U.S. trade has decreased about 6-7% already. So it used to be China has 20% of U.S. trade as a total of China trade. Now it's only 12-13%. And then yet the bilateral trade has gone up from first term to now, almost 20%. So you can see how much China is needed still by the U.S. Rather than decouple. Mm-hmm.
And I want to ask you about TikTok, because it's something that I've covered closely. Obviously, Trump's delayed this bill that would ban it in the U.S. or force its sale. Do you think there's any scenario where TikTok is not a pawn in trade talks for China in the sale of that?
Well, I can see that President Trump has made that as a topic. I mean, as a negotiating part of the negotiation. We'll see. I would think from private sector, they're probably flexible to talk, but it has to be a fair deal, if that is to be really brought into this. But also I see fentanyl. Actually, fentanyl, China has already done a lot of things already. For example, I read an op-ed by the former Assistant Deputy Secretary of State Department of Biden administration. Basically, he was saying, since they were talking with China for the last year, a lot of progress has been made. the death rate of fentanyl in the U.S. has dropped to 27%. So it's really, hard to see why Trump started on this. Let's talk. It's already a good pattern with Biden administration on this topic. But let's just continue to talk rather than just raise 10% and another 10% without even talking. So I think things can really move if both sides, particularly the U.S., is serious enough to do those things.
Mm-hmm. And Trump often expresses a fondness toward President Xi.
Yeah.
Do you think the feeling's mutual?
No, I think he's, well, he says a lot of good things about President Xi, but I think, he has started this trade war really has no justifications, really, because, U.S. maybe has some trade deficit on goods, but the U.S. enjoys enormous service trade, $1 trillion, 300 billion surplus. U.S. Dollar has been used as a global reserve for 60%, and then U.S. Dollar has been printed as to buy the world, and actually, a lot of investment come to the U.S. U.S. stock market has benefited enormously, and on top of that, also U.S. Has a great university, attract talents from all over the world. 30% of AI talent in the U.S. coming from China, basically, and of course, you can see also. The manufacturing goods of all those manufacturing, the U.S. was abandoned years ago because it was too heavy, too dirty, environmentally unfriendly. U.S. wants to concentrate on the high tech, education, biotechnology, AI, digital. So U.S. you can't just dominate all the sectors. Now you're talking about manufacturing. They want to dominate again. So I think we should have a bit more competitive advantage, and then let those. Heavy duty, manufacturing stuff. Where no U.S. actually Americans wants to do it. That was done in China, India, ASEAN. So probably to bring them all back to the U.S. is not realistic, and it was not a right choice to do that.
Mm-hmm. I'm glad you mentioned education and international students, because Trump administration's obviously taken steps to crack down on international students in the U.S. Do you think China will do anything to discourage students from coming to the U.S.?
Well, as far as I know, I didn't see that happen. President Xi actually at the San Francisco Summit 2023 with President Biden, President Xi is inviting 50,000 U.S. young students come to China. And last year, 2024, 16,000 already come. So I think it's really, that's the bond between China and the U.S. And that's where all the talents probably in the U.S. coming from. Part of that is too. And it's good for China too. You have global talent circulation. So I think it's really unwise to cut the people-to-people exchanges and target the student. I think that is a wrong move. We should not do that. And as far as China is concerned, my think tank, we publish a Chinese student study abroad every year. And it's still very strong. But also, I see the number, probably come down a little bit. It used to be 400,000 almost. Now it's still 300,000. But we love to see more U.S. students going to China. So it will be good for both countries.
Mm-hmm. Elon Musk is obviously playing a huge role in the Trump administration, though he's expected to step back soon. He does a lot of business in China. How is he viewed in China?
Well, I think he's saying something probably right. He really thinks the efficiency, because you remember the Tesla plant in Shanghai was designed, built, and rolling out of assembly line within 1 year. That's incredible speed. And then furthermore, the tariff war that President Trump is imposing on is not just on China. 70% laptop coming from China. Half of the 80-90% iPhone. iPads coming from China. And it's all made by American companies. Walmart used to purchase 80%, now 60% supplies coming from China. And then, so I see President Trump already relaxed on the laptop and iPads, all those things. But I think it's not enough. And so President Xi actually met 50 global CEOs about a month ago. And he was saying that the multinationals has contributed almost 40%, 1/3 of China import-export. Is also by the multinationals. So you are hitting those tariffs, not only hitting Chinese companies, but hitting your own companies, multinational companies, European companies. I had a big European company complain about that because they have a lot of middle parts. And for auto parts, a lot of them coming from China. So I think we're already in a very intertwined world. It's really silly to go back to the very primitive 19th century, 18th century. So it's totally intertwined. And the U.S. is dominant in so many areas, on the talent, on the investment, on the green U.S. dollars, on the digital, on AI. But you can't just say, oh, I'm going to dominate everything. I want everything back to the U.S. It's not realistic. We're in one global village. We have to really let everybody grow. And also, this is going to be devastating for all the global developing countries if the U.S., the second largest economy, got into this kind of fight.
Mm-hmm. Great. Well, we're out of time. Thank you so much. I have many more questions.
Okay, good. Thank you.
Thank you.
Please welcome Khaldoon Khalifa Al Mubarak, Managing Director and Group CEO of Mubadala, and Justin B. Smith, Co-founder and CEO of Semaphore.
Good morning. Good morning, Khaldoon. If it's still morning, welcome to Washington, D.C.
Still morning. Good morning.
Are you in Washington, D.C., or are you in some other time zone right now?
I'm on, let's see. Yeah, good timing.
Good time.
Good time. 7 p.m.
If you are a media company and you're hosting a conversation on the global economy, this is sort of the dream conversation that you try to curate, because our guest this morning really just represents so many of and it sits at so many intersections of all the conversations that you've been hearing across the last couple of days. We're in Washington at a moment when U.S. policy shifts are sending shockwaves through markets, and the world is reassessing where power, capital, and influence reside, which makes this conversation especially important. But Khaldoon is also a key architect of something much bigger, which is the emergence of the UAE as a true global economic force. Under his leadership, Mubadala has not only grown into a $300 billion platform, but it's also become a sort of strategic bridge between East and West and a defining player in the evolution of the 21st century economy. So we're really, really honored to have you, Khaldoon. Thank you for your presence. And of course, would love to kick off this conversation with your sense, given the backdrop I just described, which is quite dramatic in this moment, in this location, Washington, D.C., what is your view of the global economy at this moment, and where do you see it going?
All right, you're starting with a layup, huh? Well, first of all, thank you so much. It's a real pleasure being here today. Semaphore is my first participation, so very impressed with everything I've seen, and I'm delighted to speak to all of you here today. Thank you for your time. Thank you for your, and I hope this is going to be interesting. So we have a lot to talk about, and let's start with the easy question. I think from my perspective, if we look at particularly these last 5 years, I think the world, when we talk about massive volatility, a lot of change, challenging global environment, generally speaking, this has been the case for the last 5 years. Big disruptive events. You're talking about a global pandemic. You're talking about 2 wars, a war in Europe, a war in the Middle East. I mean, these are pretty incredible events that have happened in a very concentrated period of time. We have not seen that in over 70, 80 years around the world. So it's quite, what we've seen also is how the world's been very resilient, and the economies have been resilient throughout these quite interesting events over these last 5 years. Now, this is, again, more volatility that we were seeing here today. The funny thing, well, I don't know if it's funny, but the interesting thing was when we were looking at end of 24, close the 24, from my perspective, looking at the next 5 years, as I was working with my management team and Mubadala, it looked okay. I remember closing the year out in 24 and saying, wait, listen, we've weathered these 4 or 5 years, been quite difficult. We did very well, happy with our performance, happy how we've managed it. And now things look a bit clearer. I think the Trump administration had obviously won the election. We knew who was coming, pretty much anticipated what I thought, or we thought was going to be coming this year. And it looked like, yeah, relatively blue skies, some clouds here and there, manageable overall. Tariffs, obviously this is the subject matter of the day. I think, everybody expected something. Everybody had a base case of something. We had our own, but manageable. Now we have a situation, obviously, that we're seeing that was what this means for the U.S. economy, what this means for the global economy, what this means for growth, what it means basically for everything we do in terms of our business going forward, and how does that change or not our outlook in the short term, the medium term, and the long term. I think from a long-term perspective, let me start with that, not necessarily. I think for a global investor like ourselves, and having the benefit of looking at a 5-year and a 10-year horizon in every decision we take, it's a bit easier in that sense to manage through that. In the short term, more complicated.
Now, one thing we've heard over and over the last 2 days is in the face of these policy shifts that people are just pausing, stopping. Is that also the approach that international investors are taking, or?
Okay, I think the word pause, I wouldn't use, maybe I'll use a different word. I think this is happening very fast. And for investors like ourselves who are transacting on a regular basis, we have to look at each transaction on its own merit basis. Some of what we're seeing right now has an impact. Some not necessarily has an impact on that particular transaction with the horizon we're looking at. So I think what we are doing is changing our base case assumptions. That we are doing. And in doing so, we are taking a bit more time in terms of how we look at these investments. We're not stopping investing.
Are we entering a new paradigm, a new world, or are we just going through a short-term adjustment?
No, I think there's a shift. There's clearly a shift. I believe that. I think you're going from a different tariff environment April 1st to a new tariff environment, whatever it is, post April 2nd. So I think is unquestionable. I also believe that I think the impact of that change on growth is also clear, that there is an impact. Now, the size of that impact, we will all have different opinions on that, but there is an impact on growth, both global growth and growth in the U.S. economy in the at least 2025, 2026, these next 12 to 18 months.
And so many of these policy shifts are obviously directed towards the objective of bringing more investment into the U.S. And I think a few weeks ago you were here with a delegation, and the UAE unveiled a $1.4 trillion investment framework at the White House. Can you walk us through the sectors you're focused on, how that deal came about, how Mubadala fits into this?
So let me frame it first. When you look at the UAE has, I think, a set of sovereign funds and large institutions that have, over the last 30, 40 years, evolved to becoming really, high-quality investment institutions, such as Mubadala, such as ADIA, such as ADNOC and MGX and ADQ. We have many institutions that are coming out of that ecosystem in the UAE, very mature ecosystem in terms of institutions that are investing globally. The United States represents the biggest, obviously, market for these institutions. That's been the case for the last 30 years. It'll be the case going forward because, obviously, the merits of this economy, this great country that has consistently delivered high-quality economic output with companies and businesses in the sectors, at least, and I'll come to that point to the question, the sectors we like consistently. So the U.S. economy will always be, I think, let's say, a major destination of capital coming from UAE institutions. That won't change. So accordingly, I think looking at a 10-year horizon, which was effectively that declaration you disclosed, it follows the strategic investment plans of all these institutions, looking into account the last 10 years and how they've invested, and looking at the next 10 years and how we intend to invest, both in terms of the economy and the sectors we like. What are the sectors we like? Obviously, technology is a very important space. It's a space that I think, notwithstanding what happens to your first question, doesn't change thematically that the U.S. will continue to be a leader in that space, and that is an investment space we like to invest in and we will continue to invest in. Infrastructure is another space we like, and I think, again, the thesis continues, and I think our conviction of that sector in the United States continues. Energy is another sector we're very, I would say, capable in investing in. It's an area we've done very well over the years, and we will continue to invest. So just looking at these three general themes, energy, infrastructure, and technology, that represents what we are looking at over the next 10 years. And then with the companies and the investment institutions I've just described, that fits the theme, and that's why we're doing what we're doing.
So the president is planning to visit the Gulf, I think, in 2 weeks, and I'd love to hear your comments and thoughts, and maybe to sort of explain the nature of the U.S.-UAE relationship, and how would you characterize the partnership, and is Mubadala been a kind of a key figure, a key force in shaping the relationship across the last 2 decades?
So the U.S. and the UAE have a deep relationship. I think that's a matter of fact. For the last 40, 50 years, we've had a very strong relationship, and that relationship spreads through everything from, obviously, the economy, the energy sector, socially, going into education, healthcare, I mean, you name it. We have quite a diversified relationship. It also extends to the government and to the defense sector. If you look at the last 35 years, I think the UAE is one of 3 countries that have participated in every single U.S. coalition in the last 35 years, and the other 2 are 2 NATO members. So very close defense relationship historically. That extends to a very deep energy relationship. That extends to a very deep investment relationship. UAE investment institutions are probably one of the largest foreign direct investors into the U.S. economy for the last 20 years. We are up there, and again, whether we are in the top 3, top 4, we are definitely in the top echelon of investors into the U.S. economy. So a very deep-rooted investment relationship. We have a healthy trade relationship from a U.S. perspective. The surplus is in the U.S. favor. I think we come 3rd in terms of the surplus for the U.S. on the trade side. So quite a balanced relationship from that sense. And I think that positions us well going forward. I think whatever administration comes in, Democrat, Republican, we're pretty agnostic from that sense. We look at the U.S. as a strategic partner, an ally, and a very important economic partner.
So in the world of finance, global finance, I think it's fair to say that Mubadala, as a brand, as an organization, has been has seen a remarkable growth and rise in relevance. I think you were deployed more capital than any sovereign wealth fund in the world last year. How have you scaled Mubadala? How has Mubadala gone from a sort of an unknown entity into this powerhouse of the global financial world?
Well, we very much, I would say, went in parallel with the UAE growth and development story. If you look at the last 20 years, from when Mubadala started as a sovereign fund, we were predominantly an energy company to start. Our portfolio was pretty much 100% energy. And what the UAE has done very effectively over these last 20, 25 years is diversify away. We are a country that is, our foundation was on oil and gas. That used to represent over 70 or 80% of our GDP. Over these last 20, 30 years, that has flipped, where oil and gas or energy represents less than 30% of our GDP. Mubadala, 20 years ago, 100% was energy. If you look at me today, 20 years later, we've grown to becoming one of the largest sovereign funds in the world. And our portfolio is now predominantly, actually over 80%, non-energy related. So we've kind of mirrored that transition and that evolution of as an investment institution. With that, I think performance was a key part of our development. It was, how do we build this institution to be a high-performing investment company that outperforms the market, outperforms our peers, brings value to the UAE by bringing in partnerships and investments in sectors that create both jobs and high quality economic value to the country, and invest globally in the sectors that we see are the sectors for growth. In doing so, today, Mubadala is considered, not considered, I think our performance justifies that, one of the highest performing sovereign funds in the world in terms of returns. And that's what I care about. Forget size. Returns is what I care about. It's about output, and it's about what we can do and what we perform. And we are really in that stage, and I'm very proud of that.
Someone was joking to me outside that had it not been for tariffs, everyone would be talking about AI all the time. So thank you, tariffs, for that. But obviously, AI has been a really big part of your focus, of the UAE's focus. We have G42's CEO here. Talk to us a bit about your views on the AI investment landscape.
So huge believer in that space. AI is going to transform the world, and I think full conviction behind that. We've taken that view for many years now as a country and as an institution. As a country, you go back to 2017, we had the first government minister for AI. I think one of the first, if not the first country around the world to do so. 2018, we established the first AI university, MBZ AI, 2018. And I think the UAE government has been very much on the front foot in terms of AI enablement and the development of that sector and that space within the country. So we're very much on the frontier end of it. As an investment institution, it's obviously a sector that we are very focused on. Very focused on. We've been doing it. We've been investing in it for years now. We are continuing to heavily invest in that space. And our view is, particularly on the AI enablement side, which we think is where we can extract the best alpha value for us, given our, obviously our capital strength, our energy strength, and our ability to execute large projects. Obviously, data center build out, and that data center build out capacity that can help in AI, both enablement and dispersion, is where we are focused on. So we're spending a lot of time on that. We're investing a lot of, obviously, capital into that space. The UAE is well positioned. I think the UAE is well positioned because we have a government that's forward-leaning on this. We have investment institutions, like Mubadala today. AI is pretty much in every aspect we do, in the way we decide, in the way we analyze, in the way we operate. I don't attend any investment committee right now without our AI vector being part of it. Today it's non-voting, but at some point we're going to make a decision on that. We will make it a voting member of our investment committee. But by the way, it's happening. It's working. I mean, I had an actually interesting meeting last week with my investment committee where I said, listen, I'm not attending a single investment committee of any of our companies or any board that we don't have right now AI vectors as part of the decision-making process.
What AI vector?
It depends. It depends. You got to be, again, agnostic in this. So if I look at, let's take one step out of this. How do we invest in AI? We have today MGX, which is a vehicle we've jointly created, Mubadala and G42, which is very much focusing on that space. They are agnostic. They are, I think, probably the only investment institution that is invested in OpenAI, Anthropic, xAI, Databricks. I mean, again, we're taking an approach where we're trying to invest in all the companies that we think will be winners and doing it in a very thoughtful way. Going back to your question, again, same thing, in developing these language models. We are using multiple models, and we're testing and seeing which ones work, and we're combining some of them, and we're creating our own. So it's something that is now pretty much at the heart of everything we do.
So the final question, which I think is often on the minds of a lot of big global people thinking globally, is as the U.S. and China look like they're sort of on an even more significant collision course, the acceleration of decoupling, how do economies and companies that are sort of in the middle navigate that most successfully?
I think countries in this environment have to look after, this question is quite a multifaceted question, because you have to look at it from the lens of trade. You have to look at it from the lens of technology. You have to look at it from the lens of geopolitics. So it is not a one answer for each for all these countries. These countries in Asia will have to look at China as a. I don't think there's a country in Asia that wouldn't have China as either their number one or number two trade partner. So they have to look at it from that trade lens. Not a single country in Asia doesn't have to take a view on technology. And right now, it's very clear. Are you going to go with the US technology solution or the Chinese technology solution? These are questions that these Asian countries all have to think about and decide as they go about their business. And then there's the geopolitics. And again, without mentioning names, each country has its own realities. And I think one of the mistakes many folks make is thinking that this is a one-dimensional answer that I can give, that it's a cookie cutter that applies to every country in Asia. It absolutely isn't the case.
So just one last question. As someone who spent early part of my life in cities like Singapore and Hong Kong, it's remarkable to see the rise of Abu Dhabi, the rise of Dubai, these Gulf cities, almost sort of becoming this generation's version of those ascendant, very ascendant places. How did you pull this off? It's remarkable. I mean, the changes in Abu Dhabi in the last 10 years are just really unbelievable. How did you do it?
I think the great thing about the UAE, from obviously my perspective, and it's a very subjective view, is we've had 50 years of consistent, solid leadership. We've had 3 presidents, and that led to a very consistent strategy. I think with the UAE, there's no surprises. If you look at the last 50 years, it's been a steady growth story. It's been a steady evolution of a country from what it was. If you were to come to Abu Dhabi in 1972, and if you look at Dubai and Abu Dhabi now in 2025, that transformation is as a result of, I think, ultimately good management, good leadership, a clear vision, execution on that vision. And then today, it's steady Eddie. There's no surprises. I think it's, from a UAE perspective, we take a 5-year, 10-year horizon always. The people are at the heart of every decision. When you go to the UAE and you've traveled there, you'll see we have a very high quality of life in the UAE. We have education at a high level, both primary and collegiate. We have high quality of healthcare. We have a safe country. It's very safe. I know we're in a very interesting neighborhood where to say the word safe and the Middle East is kind of strange, but it is a very safe country, and the history, I think, and the records, obviously all the records say that. So I think the combination of safety, high quality of life, education, healthcare, good economy, diverse economy, there's no great management, strong leadership, steady, consistent, no surprises. It's no surprise that if you look at 2024 and 2023, the largest, in terms of high net worth individual movement around the world, the largest recipient of migration of high net worth individuals in the world was the UAE, 2023 and 2024. Number 2 and number 3 were Singapore and the United States. In both these years, the UAE was as much, if not more, than both of them combined. That doesn't happen if it wasn't for all what I've described before. That's stability of vision, stability of direction, good management. You know what you're going to get when you go to the UAE. You know you're going to land in a high-quality airport. Well, you know if you're going to fly in one of our airlines, you're flying in a high-quality airline. You're going to land in a high-quality airport. You're going to go on high-quality infrastructure. You're going to have good highways, high-quality telecommunication. You know you're going to go to a good high-quality hotel at hopefully a good value in terms of price. And I think today what you have is these institutions across the board, whatever sector it is, energy, financial services, banking, investment, that are of high quality. That's why it's been a success.
Great. Well, listen, with that, thank you so much, Khaldoon. It's been a great honor to have you. Please join me in thanking Khaldoon for his comments.
Thank you very much. Thank you for your time.